Significant ones come from the European Union, which started to track emissions a few years ago and is now looking to include shipping emissions in the emissions trading system. So that would significantly reduce and help calculate the emissions from the shipping industry. Now, China is taking similar steps. So at the moment, regions need to report shipping emissions to the central government. And finally, we have the International Maritime Organization with a pledge to reduce shipping emissions by 50% in 2050. Now, we must say that that pledge has been considered insufficient by environmental groups, but at least some steps are being taken.
So to get to 2050, the industry obviously is going to need to start tapping some new technologies. What new technologies are you seeing being introduced into the shipping industry?
So we have seen pilot technologies being developed for years now, but what's interesting about this current moment is that we're seeing big players invest in these technologies that are not yet economically viable, but that one day might be. So for example, we are seeing earlier this year, the world's largest agricultural commodities trader, Cargill, saying they will invest in attaching sails to their ships so they can make any technology that they run their ships on more efficient. Similarly, we have seen a spin-off of Airbus, the aeronautics company, developing a similar application with kites. We have been following also developments in hydrogen. So at the moment, hydrogen fuel seems like a good option, a possible option when it has been developed and when it becomes economically viable. And we have Vestas, for example, the world's largest turbine maker, developing some ships that will be able to run on hydrogen in the near future.
Coming up, rising sea levels means humans need to get creative when it comes to coastal defenses. But how do we protect both ourselves and the environment? One Israeli startup may have the answer. That's coming up next. This is Bloomberg Green. In London, I'm Anne-Marie Hordern. This is Bloomberg Green. After water, what's the resource that humans use the most? It's concrete, 3 tons a year for every person on the planet. And engineers estimate it's used twice as much as all other building materials combined. And it comes with a huge environmental cost. Concrete, not just in cities, it's a common feature on our coastlines too. And that's taking a toll on biodiversity. But one Israeli startup has found a way of making sea defenses stronger and encouraging life to thrive.
If you take a look at concrete structures like breakwaters or seawalls, the water around them is often clear. That's not actually a good thing, because it means there's no life. Marine species are actually most abundant in coastal areas, but it's also where us humans prefer to live too. So when we build here, we drive away marine life.
Concrete in the marine world has a lot of additives, a lot of chemicals, and some of those materials are actually leaching out, and they're actually prohibiting marine life to thrive. If we keep developing without any regards to natural communities, there is a tilting point from which beyond we cannot really go back.
In the coastal city of Tel Aviv, an Israeli startup wants to revolutionize our urban coastlines. Their sea defenses are transforming lifeless man-made structures into teeming ecosystems. They do this by replacing standard concrete with their own special cement formulas.
As opposed to regular cement-based concrete, e-concrete includes certain elements that enhance the growth of marine flora and fauna of plants and animals. Our admix, which is kind of our secret sauce, is basically kind of sealing the concrete, making it less aggressive for the marine environment. That once we add it, we enable life to flourish.
In the lab, the team run tests to identify what mixes will work best for marine life.
So we take really ice cube size concrete slabs of different compositions, and we put larvae, 20, 30, 50. We need to have a lot of replicates. We're geeky scientists, so we have to have a lot of replication and controls. And then within a few days or just a few weeks, we can get an answer on their preference. So obviously, if they die, they have a very low tolerance to that specific concrete mix design. And if they thrive or they flourish, we can quantify that very quickly.
E-Concrete says it typically sees double the biodiversity of regular grey concrete. From fish and sea caterpillars on their armour blocks to crabs on these tidal pools that sit on the shoreline.
This unit holds water during the low tide, so it's always moist, and therefore it has a very comfortable habitat for crabs and sea anemones and sea stars, etc. These pools have been here for less than 3 months, and this is already what you can see. It's covered with life. See the rock around it, which has been here for probably 10, 20, maybe even more years, only has a thin layer of green algae, and that's it.
As well as the composition of the cement mix, E-Concrete designs its products specifically to the marine environment it will be deployed, to create niches for endangered species, or to develop nurseries like these oyster beds. The final part of the equation is creating complex surface textures to mimic natural rock or coral, an environment that helps anchor young organisms.
When concrete elements are being cast, the typical goal is to have a very slick surface, very, very smooth. The idea is to get the water to flow right across it. When we're designing E-Concrete with a rough surface, we want to do the complete opposite. We want to slow the water when they are crossing the structure so that the larvae can actually adhere and attach to the surface.
E-Concrete has to offer its clients more than just ecological credentials. Over time, they've discovered that creating hospitable habitats for marine life adds another advantage, one that is surely hard to ignore.
We've seen evidence to the fact that the growth of the organisms on the concrete create kind of a layer of defense. Just the addition of weight, we can actually gain stability and strength over time.
This is let's say the unit when we put it in the water. And this is after a year in the water. And what you can see here is all the oysters are completely covering it. We designed the units so they can withstand the forces and perform in terms of structural performance, but they can also be a backbone for ecological enhancement.
The company tests its miniature designs in tanks full of real seawater, rocks, plants, and animal life from around the world.
What we're looking for is the accumulation of calcium carbonate on the surface of the concrete of different mixes and different designs. This is the process that we call it biogenic buildup. So with time, we get a buildup of calcium carbonate that is sourced from marine organisms on the surface of the concrete. And we actually encapsulate the concrete with a natural rock. So when the organism die, in case of a coral, it will die, and then another coral will sit on it, and that's how a reef is growing.
The hope that our man-made structures could become stronger over time also means better economics. The units require less maintenance and could therefore stay in the water for longer. E-Concrete, though, is just a few years old, so it needs more time to really quantify the longevity of its products. But the company are certain their products are better for the environment, and not just in terms of improving biodiversity.
We're kind of trying to offset some of that immense carbon footprint of the concrete industry.
Construction is responsible for about 11% of global carbon emissions. By adding a biological crust to their products, E-Concrete prevents some CO2 from being released into the atmosphere.
For every kilogram of calcium carbonate being created by those marine organisms, we're offsetting 120 grams of CO2. So think about building a port infrastructure or a city waterfront that is an active carbon sink. I think that's a great advantage of the technology.
That does it for this week, but let's keep the conversation going on Twitter. Follow us at Climate I'm Anne-Marie Hordern, and this is Bloomberg Green.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. It is a down Tuesday. Stocks selling off again with the Dow, the S&P, NASDAQ very much on the minus side. Big tech getting crushed in a jittery day for U.S. markets. Producer prices jumped, posting the biggest increase on record. S&P down 58, a drop of 1.3%. The Dow down 174, down 0.5%. NASDAQ lower by 308 now. That is a drop of 2%. NASDAQ 100 index also down by 2%. 10-year yield 1.43%. Spot gold is down 0.8%. 17.71 the ounce, while West Texas Intermediate crude is down 1.2%. $70.47 a barrel on WTI. By this time tomorrow, we will have heard from the Federal Reserve. As for what to expect from the Fed, Margie Patel is Senior Portfolio Manager at Allspring Global Investments.
I'm expecting the Fed to not make a policy mistake. Historically, their mistake has always been slamming on the brakes, telling banks not to make risky loans, and precipitating a recession. I'm absolutely sure they've learned from that. They're going to err on the side of easing, as they've been doing. They want to keep rates very, very low. Nobody really benefits, in their opinion, from a big jump up in rates, especially when a huge chunk of our debt is actually owned by foreigners.
Margie Patel of Allspring. Big tech names are slumping, among them Facebook, down now by 0.8%, also known as Meta. We've got Apple, lower now by 1.3%. Amazon down 1.5%. Netflix is slumping 2.7%. And Google, rounding out the FANG names, lower now by 2.1%. That is Google, the parent of Alphabet, parent of Google, Alphabet, lower now by 2.3%. So again, recapping, it is a down day with the S&P slumping 59, lower now by 1.3%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Good afternoon, everyone. Live from the Bloomberg Interactive Broker Studio. We are streaming on YouTube. You know, it's going to be a rough day when it says swipe again because I can't get in. It's just one of those.
It's just you got to.
Do you think the Fed has that kind of thing when they're kicking off their meeting?
Well, that's what they're doing today. I mean, You know, Jay Powell has, of course, you know, from the 60 Minutes interview, we see that he has the terminal right behind him.
I know.
Of course he does.
I wonder if he has problems swiping in. Anyway, I'll get there. So we do have the Fed kicking off its two-day meeting. Big tech being a big drag again on the equity markets. That jump in producer prices, I guess, making investors wonder, all right, so how inflation will maybe impact that Fed decision tomorrow?
Yeah, that's something that we are going to be talking about throughout the show, including in just a couple of minutes. Inflation jeopardizes the Fed's goal for inclusive employment. That's a question that we're asking today in Bloomberg Business Week.
Yeah, exactly. We know Jay Powell has been out there saying it has to be improvements across the board, but we'll see whether or not having hot inflation makes it more difficult to keep that mandate. We're also going to hear from the Uber CEO.
Yeah, speaking of higher prices, right?
Yeah, exactly. So we'll get to that. And we've got the latest on COVID from Michael Dowling, President and CEO at Northwell Health. They are a massive healthcare system in New York City and the New York area. And what's key, 1 year ago, that system administered the first COVID vaccine in the United States just 12 months ago.
Yeah, it makes me think that we thought at that point that we'd be in a different place than we are today. We're going to talk about that with Michael Dowling in a few minutes. Also, the Bloomberg Big Take today, it's all about guild education, how to get rich sending low-income workers to college. A lot of questions about that.
Okay, and also what happens when you live alongside the homeless. For one remarkable woman, you do something about it. We're going to talk with the founder of Street Team Movement. So much to come. Let's get to, though, the Market Drivers Report. Let's set that Business Week agenda on this. Yep, it's Tuesday. I'm still trying to log in. Having said that, in our interactive broker studio, I have Kriti Gupta, Bloomberg Markets correspondent at Bloomberg News, Abigail Doolittle. She's markets reporter at Bloomberg News. Like I said, both in our studio. It happens when your hands get dry in the winter months. They're all nodding because I can't get in.
If you have any questions, I will find you the information, okay?
I'm going to keep trying. All right, Kriti, take it away. What are we seeing?
Yeah, well, a major sell-off just like yesterday. I mean, this is pretty natural on a week ahead of the Fed. I think the margin of the move is what's significant here. It's not a secret that everyone's waiting for what the Federal Reserve is going to say, what they're going to do. And traditionally, before the FOMC rate decision on Wednesday, Monday and Tuesday tend to be pretty choppy, and then the market kind of recovers Thursday, Friday. That being said, this time around, it's not expected to be a dovish message at all. So I kind of wonder.
But we knew that. What happened?
It kind of seems like the markets went from a perhaps wait-and-see mode to a we know what's coming, let's act on it now mode. But maybe Abby has a different take on that.
Abigail Doolittle, come on in here and give us your take. Because if we think about the differences between what we knew yesterday and what we know today, the PPI came, but other than that, what other information did investors get that could cause I think it's fair to say, a sell-off in tech like we're seeing today?
Nothing all that new, really, just the expectation that perhaps the Fed is going to be a little bit more hawkish than expected. If we think about it, back in September, they weren't expected to hike rates. They were just talking about the possibility of 2022. Now we're looking at 2 to 3 rate hikes. They're also, most economists are expecting that they're going to pare their balance sheet in March.
We're still going to be at really low levels.
Yes,
even
super
2 to 3 rate
low levels. Right? And the balance sheet remains blown out. So even if they stop buying bonds, it's not like they're selling. To Kriti, in terms
That's an important clarification, though.
It is. It's a big clarification because it's not like their balance sheet. I think their balance sheet is at like $7 or $8 trillion. That's a lot of accommodation, a lot of liquidity in the system. In some cases, you could even make the sense that if we don't have the economic growth that folks are expecting, that there's more fear of the dreaded liquidity trap, where the liquidity is simply not moving around. So they have to think about how to drain it while not creating some sort of inflation. But in terms of the tech sell-off, clearly about rates rising. And, sometimes in Fed weeks, sometimes you have choppy action like this, but more often the Monday and Tuesday and Wednesday ahead, you have very small moves, everybody waits, and then on the information. So this is a little bit different in my mind.
The volume's there?
The volume is not there, so that's an interesting point. We're 5% below the 20-day moving average. So I think that these are just pre-nervous jitters. Cameron Kreis, macro man, he had an interesting point. What will actually be a hawkish surprise if we're now counting on, stopping to buy bonds in March and 2 or 3 hikes in 2022? It have to really be something to surprise these markets and spook them.
We're doing it today.
Yeah, we're already getting that out of the way. But something else to think about, last week was the best week, I believe, since February. So a little bit of consolidation of that, the back and forth. We've had this for a while. The VIX is above 20. Investors are a little bit on edge. You've had this huge rally over the last 2 years. And Microsoft really jumps out to me. It's down 4%, worst day since October. And really, to my eye, no news. So I think that it's more, this has been a huge winner. It's had a huge run. Take some chips off the table in case the Fed does have some kind of hawkish surprise.
I'm glad you said that because I was confused about Microsoft. It's one of my decliners today because as far as points go, it's dragging the NASDAQ 100
Almost,
lower.
what, 11% of the NASDAQ 100?
Yeah, it's responsible for 70 points of the decline right now.
Yeah. Good calculation, Tim. I'm impressed.
I've only been here for about 14 months, and I'm slowly learning how to use the terminal.
I would say you're
I have a great
learning.
teacher right here, okay, Carol.
He's really good.
Best.
He's coming his way through. But it's
Go ahead.
perspective. I think it's important perspective. And we laugh about, we can't say, well, they're taking money off the table. Investors do that. There are investors who actually say, right, Queenie, hey, we made some really good gains here. We're also coming to the end of the year, and you start to look at your portfolio. Yeah. You think about tax consequences. There's a lot of things that are at play potentially.
Yeah, absolutely. And to your point, I think the key word that you said is we're nearing the end of the year, right? Because it's not just month-end rebalancing, but it's quarter-end rebalancing and year-end rebalancing, and tech in particular has had this incredible run-up. So to your point, but I should also mention that JP Morgan came out with a note this morning that's actually shaken a lot of the information technology stocks in particular, warning against rising rates in particular. And in doing that, they've actually kind of rattled a lot of those software tech companies, likes of Adobe, for example. And recently in the run-up, the information tech sector has actually made up, I think, about 39% of the S&P 500 now. Their weighting on a sector basis is much, much larger now. And in the last couple of weeks, than it has been. A good chunk of that is that monster day we had from Oracle and Broadcom just a few days ago.
I feel like all the strategists are weighing in, like, don't worry, do worry, don't worry, do worry.
Agreed. There's not a lot of consensus out there.
Somebody's going to be on the right side of it, potentially.
Agreed, because I think Morgan Stanley for the year-end target for 2022, and that's a huge, huge way out, but I think that they're at 4,400, and then you have maybe Bank of America, or I don't remember what big bank, but at 5,400. That's a 1,000-point gap. I mean, that's not a fine-tuned range. And one of those analysts or strategists is going to be very right or very wrong. Or even if they're in the middle, they're still going to be very right or very wrong.
Abigail, what are the technicals that we need to keep an eye on?
So the S&P 500 is coming down onto its 50-day moving average. I always watch Apple as the biggest point.
That's pretty wild because it just hit a record last week.
Well, agreed. So that's the choppy action we're talking about. And we've been in this period over the last couple of months where we have a few weeks of risk on, everybody forgets about the bearish sentiment, and then a few weeks of risk off, everybody forgets about the risk on, the bullish sentiment, and now it's actually week by week, it seems. Tomorrow's meeting does feel like it could be one of the more binary Fed meetings that we've had in quite some time, just the way that stocks are trading into it. Because to my recollection, usually ahead of these meetings, you have these very small moves, and investors are just kind of treading water, waiting to see. But here you have big moves. But to Creedy's point, in terms of the end of the year, that's a big point also. You don't have that much more time to take care of tax considerations.
Yeah, you're probably feeling a little bit squeezed. All right, guys, thank you so much. Abigail Doolittle, she's markets reporter at Bloomberg News, and Creedy Gupta, she's our Bloomberg Markets correspondent at Bloomberg. She'll be back a little bit later on with her chart of the day. Let's do the bite of the day.
It's one number that tells us a lot, and it's brought to you by GEP. GEP helps businesses transform supply chains with strategy, managed services, and AI-based cloud-native software. You can learn more at GEP.com.
Today's number, it is 15. Europe's $1.8 trillion year of M&A deals may be topped in 2022. Wow. Citi strategists predict 15% growth next year. Deal making in Europe is having its best year since 2007, buoyed by PE firms flush with cash and UK companies that appear undervalued. Got to say, for the U.S., I believe it's going to be a record year.
Best year since 2007. What happened after that, Carol?
Another crisis.
Okay, thank you.
All right, you're listening to Bloomberg Business Week. Carol Massar, Tim Stenovic. You're listening to Bloomberg Radio. All right, you are listening to Bloomberg Business Week. Carol Massar along with Tim Stenovic, and we're going to talk a little bit about COVID because it was 1 year ago that the first vaccine was administered in the United States right here on the East Coast, and we're going to talk with the head of Northwell Health in just a moment. In the meantime, you are seeing more companies quickly come out, including JP Morgan Chase, now requiring vaccines to enter 9 Manhattan office buildings, including its headquarters at 383 Madison Avenue.
Yeah, the mandate goes into place on Tuesday. That's according to an internal memo seen by Bloomberg News. Unvaccinated employees have been asked to work from home temporarily until, quote, alternative solutions are considered. That's according to the memo that was sent to staff yesterday. The decision comes one day, or I should say, I don't want to say a day, but the decision comes after New York State instituted a mask mandate for businesses that don't require proof of vaccination.
Yeah, exactly. And what they're saying too, right? They've got, and we're seeing this with companies who are saying, we've already got a vaccine mandate policy, right? And so, they're just kind of laying down more in terms of what needs to be done. What's interesting, Tim, and I think we see this so quickly, we've seen this before, we know that there are spikes, so what do? We throw on our masks or wear them more than we were before. We go back to social distancing. We're doing testing. Like, we have so many different tools that we did not have a year ago or, a year and a half ago when all of this got underway. I mean, so we know what we need to do to quickly, hopefully, reduce those numbers of cases and more importantly, hospitalizations and then, of course, deaths.
Right. Also today, we're learning that Apple is, again, requiring masks at U.S. stores and limiting crowds. Apple has a unique view because they have data from all over the world, and they have to come up with policies that work in different geographies. And what they decided to do is reinstate safety measures at U.S. stores.
Yeah, and what's interesting, you go to an Apple store, right, it's often people from all over the world that are in there. They're big, open environments, lots of people.
It's about touching and interacting with the products, right?
You're all touching the same products. And so when they do something, and I do remember when there were key metrics, whether it was Starbucks shutting down or Apple closing stores, those for us during the pandemic were very key in understanding, right, where we were. All right, you are listening to Bloomberg Business Week. Carol Master, Tim Stanovic. We're going to have more on COVID in just a moment. Stick around. You're listening to Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
I'm Charlie Pellet. Down Tuesday, we're off session lows, but still lots of red on the screen as the Federal Reserve gets ready to wrap up its final meeting of the year. Another report showing inflation running hot sank some of the most expensive pockets of the stock market. NASDAQ down 1.6% right now, down 250 points. The NASDAQ 100 index down 1.6%. Russell 2000 down by 0.9%. S&P is down 46, lower by 1%. Dow Industrials down 92, down 0.3. 10-year yield 1.44%. Spot gold down 0.8%, 17.72 the ounce, while West Texas Intermediate crude is down 1%, 70.60 a barrel. New York State's Ethics Commission has voted to require former Governor Andrew Cuomo to repay the more than $5 million in compensation he received for a book he wrote in 2020 on his handling of the COVID-19 pandemic. Cuomo, author of American Crisis, Leadership Lessons from the COVID-19 Pandemic, will have 30 days to return the money. Recapping S&P down 46, down 1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. It was the shot seen around the world. 1 year ago today, Sandra Lindsay, the director of patient care at Northwell Health's Long Island Jewish Medical Center, became the first person in the U.S. to get the COVID-19 vaccine. We all watched or saw the video right after it happened. And Tim, that press conference of the event said to be viewed by some 6 billion people at that time or shortly thereafter.
Wow.
Yeah, I mean, it was monumental. I remember, right, we were all working up to the vaccine, and then to finally see it being put in a healthcare worker's arm was a big deal.
It was a big deal, and it's sort of, I think a lot of people would be fair to say that this isn't really where we thought we'd see ourselves in a year. Apple asking people to put masks back on. Hospitalizations in New York are up significantly after the holidays, and Governor Kathy Hochul saying she's frustrated by this need for new restrictions.
All right, so let's see what Michael Dowling, President and CEO at Northwell Health, which is the largest healthcare provider and private employer in New York State. He's also written several books. He joins us on the phone from Long Island, New York. Michael, thank you so much. You have been so gracious always throughout the pandemic.
Thank you so much. Appreciate it. And anytime, thank you so much. I appreciate it.
Well, we do too. How are things going? What are you seeing front and center when it comes to where we are in the pandemic?
Well, a couple of points I want to make is, one, this is, as you mentioned, this is a very special day, and it's also important to remember the success that has occurred since then. We're in a much better position today than we were a year ago, but everybody has to understand that this is a marathon. It's not a sprint. We still have a lot of work to do before we completely exit this pandemic crisis, and people have to be a little bit patient and have to put up with some inconvenience and some disruption. And if we are willing to win the war against COVID, then we have to do what is right to do. So today, we have 345 COVID patients in our hospitals. That's about double what it was prior to Thanksgiving.
Wow.
And we do anticipate, now that we're going into the Christmas week, that we will see another bump up in hospitalizations post-Christmas. We don't know exactly what the numbers will be like, but we're anticipating that we will see an increase. So the positivity rates are going up, but the hospitalizations, at least in the city, in downstate, while they are increasing, we do not have in any situation a disastrous circumstance. We're easily able to handle it. The volume is not too much. We're handling it. It's different than what's happening upstate and in other places around the country.
Well, Michael, tell us, if you can, how many of those patients who are in the hospital right now are people who are vaccinated?
Less than 20% are vaccinated, or that means over 80% of the people in the hospital are people that are unvaccinated. So in many ways, we have an unvaccinated crisis, a crisis of unvaccinated people. And that's the issue. That's disturbing, because we know the vaccine works. We know it can dramatically reduce the illness and dramatically prevent hospitalizations. And the fact that people are still out there making all sorts of arguments that they shouldn't get vaccinated, in my view, makes absolutely no sense. If there are people who are in the hospital that have been vaccinated, and have COVID and are sick, which are few in number. But these are people that in most cases have other major medical issues that they're suffering from. The vaccine, if you get the vaccine, it will limit the illness, and it will, in all likelihood, dramatically limit the need for any hospitalization. So it definitely is proven to be successful.
Younger, older? Is there something interesting in terms of the group of people that are?
Yeah, well, they're older, and especially the people who are in the ICU and quite sick. But the sickest ones are the ones that are unvaccinated.
Let's also talk a little bit about gun safety, because something that you're doing, Michael, and that you've been doing at Northwell Health for the last 3 years has been the Gun Violence Prevention Forum.
Right.
Ambassador Susan Rice is going to be headlining it. I'm wondering about how that fits into our idea of public safety, especially during the pandemic.
Well, in many ways you could argue we have two pandemics. We have the COVID pandemic, and we have a pandemic of gun violence. I mean, we've had over 600 mass shootings this year alone. During COVID, gun ownership increased, the sale of guns increased, et cetera, et cetera. And we just what we saw in Michigan last week with that 15-year-old. We have a real crisis here. So we've been working on this for a couple of years. And my position is that we have to look at gun violence as a public health issue, because we see the results of it in our emergency rooms, in our psych wards, in the dislocation of families and the disruption of families, etc. We see the medical and psychological issues as a result of gun violence. So it's a public health issue. And I believe large healthcare organizations have to broaden their concept of health. It's a lot more than just the provision of medical care. So we have to be out there as catalysts and advocates to look much more broadly. And gun violence is one of those issues. So tomorrow we do have our third national meeting, and Susan Rice is one of the headliners. We do have a big meeting in Washington on Thursday night, where we have a dinner with a lot of the key people from around the country. And we've developed a learning collaborative. I've been trying very hard to get a lot of the health systems around the country to stand up and basically say, yeah, this is in our lane. This is what we should be working on. This is a public health issue, and we've got to deal with it.
Well said. Another pandemic and an important public health issue as well. Michael, thank you so much. Happy holidays, and be well and stay safe. Michael Dowling, he's President and CEO at Northwell Health, as we said.
broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C., Bloomberg 99.1 to Boston, Bloomberg 106.1 to San Francisco, Bloomberg 960 to the country, Sirius XM Channel 119, and around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
Yes, indeed, it's Bloomberg Business Week. We're in an interesting time where the Fed is kicking off that two-day meeting. We'll get a decision tomorrow. It's a few weeks before, 3 weeks before we start to get earnings. Maybe even, no, it's really about a month before we really get into earnings
still
season.
getting earnings.
Yeah, a tail end, but I mean when we kick off the next earnings season. But what's great is when we talk to CEOs, and our Emily Chang did catch up with the Uber CEO, so we're going to see what they had to say.
Yeah, Dara Khosrowshahi, we're going to hear from him in just a few minutes. In the meantime, a check of what's going on with the trading day, because we are off of session lows. Here's Charlie Pellet.
And we are looking at red on the screen, though, Tim, but yes, absolutely right, off session lows. You mentioned we've got the Uber CEO coming up. Both Uber and Lyft, they're based in San Francisco. Shares of both companies are higher right now. Uber up by 4.1%. We've got crosstown rival Lyft up now by 2.1%. But it is a down day on Wall Street here. By the way, this time tomorrow we will have Fed Chair Jay Powell on the air with the news conference. We'll have that for you live on Bloomberg. As the Fed gets ready to wrap up its final meeting of the year, another report showing inflation running hot sank most of the some of the most expensive pockets of the stock market. NASDAQ now lower by 1.5%, have been down 2% plus. The NASDAQ 100 index down now by 1.5%. NASDAQ, by the way, down 236 points. S&P lower by 44, down 1% right now. The Dow down 112, a drop there of 0.3%. 10-years down 6/32, 10-year yield 1.43%. Spot gold down 0.8%, 17.72 the ounce, and West Texas Intermediate crude down 1%, 70.61 a barrel. Bitcoin, an up day, up 0.5% right now, 47,070 on Bitcoin. New study data shows Pfizer's experimental COVID-19 pill was highly effective in keeping patients out of the hospital, but less adept at erasing milder symptoms often associated with breakthrough infections. So it raises the question, how much closer are we to treating COVID like the common cold? Dr. Amish Adalger is senior scholar at the Johns Hopkins Center for Health Security.
Every time we get a new tool to use to treat people, to keep them out of the hospital, we get closer to that goal. And I think that the antiviral from Pfizer is one of those tools because it has a tremendous ability to prevent people from becoming hospitalized. And that is what this is all about. That's what flattening the curve was about, preserving hospital capacity. So I do think we're getting there.
And Dr. Adalger with the Johns Hopkins Bloomberg School of Public Health, which is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Checking some of the vaccine stocks that we track every day at this time. Pfizer up 0.8%. Its German partner BioNTech, those ADRs down 1.1%. AstraZeneca's ADRs down 0.1%. Moderna up now by 1.1%. Johnson & Johnson up by 1.1%. This headline from the Bloomberg Professional Service, the FAA casting doubt on the Department of Justice's case against a pilot in the Boeing MAX probe. New York's COVID-19 hospital 70% since the Thanksgiving holiday, prompting officials and businesses alike to reassess their policies in an attempt to blunt a winter virus surge and the onset of the new Omicron variant. J.P. Morgan Chase will require vaccines to enter 9 Manhattan office buildings, including its headquarters at 383 Madison, and Apple is reinstating its mask mandate at U.S. retail locations. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. And of course, Charlie mentioned that headline. The FAA officials have approached U.S. prosecutors to warn them that the lone person charged with a crime after the 2 fatal crashes of Boeing's 737 MAX is being made a scapegoat, according to a court filing in the case.
And earlier today, a Bloomberg Technology anchor Emily Chang spoke exclusively to Uber Technology CEO Dara Khosrowshahi. In this excerpt, Khosrowshahi talked all about what's driving this quarter's profits. Check it out.
Last week for us was our best week ever in terms of volumes, and mobility volumes now last week were pre-pandemic highs. So the world, despite Delta, Omicron, et cetera, continues to reopen, and as the world reopens, the mobility business continues to get better and better. And then on the delivery side, delivery is incredibly sticky. It's a great experience, and we're adding grocery experience to it as well. So the delivery business is also hitting all-time highs, which makes the whole company hit volumes all-time highs last week. That we do think is going to translate into profits. And at this point, we're confident that on an EBITDA basis, we're going to come in at the mid to high point of the range that we gave earlier to our investors. So far, so good.
So let's start with delivery. How do you keep that growth going as the world reopens?
Well, what we've seen with delivery is that it's a sticky habit. It's a little bit like Amazon. People used Amazon pre-pandemic. There was an acceleration, and the majority of people who experience the delight of any food, any restaurant that you want within half an hour, they tend to stick around. So we're seeing delivery audience growth of 25% on a year-on-year basis. We're seeing frequency grow, and we're seeing basket sizes grow as well, which translates to very strong delivery volumes, and we expect those volumes to continue. We're also adding selection, not just selection of restaurants, but now we're adding grocery, convenience, GoPuff, so that essentially if you forget toilet paper, et cetera, you can order an Uber Eats and you can get it inside of half an hour, which again adds to the frequency use case of our service.
Now, mobility, new post-pandemic high. Will it ever surpass pre-pandemic levels again? And if so, when?
It absolutely will surpass pre-pandemic levels. And for example, if you look at mobility bookings in Europe, they're already higher than pre-pandemic levels today. Same thing in Latin America. On a relative basis, the US and APAC are lower than pre-pandemic levels, but we see it over and over again. Every use case is coming back. Workday use case, weekend use cases, travel's trailing a bit, as you would expect. But the pattern that we see over and over again is as cities open up, as countries open up, volumes actually come back, and they eventually exceed pre-pandemic highs. I can't tell you exactly when, because I'll be trying to predict the health circumstance, et cetera. It's difficult, but I am quite confident that next year we will be hitting records, all-time records in terms of mobility bookings. I'll make that prediction now.
Okay, good to know. All-time records next year in mobility.
Yes.
Omicron, though, the threat is rising here and around the world. Are you seeing any impact? Is it impacting airport rides? And honestly, how worried are you?
So we are not seeing any kind of an impact in our business as we speak. Again, last week was an all-time high for our mobility business. This is an uncertain world. And I think we as a company now, because of the global nature of the business, some countries open up, some countries might be closing down, et cetera. On average, the world is getting better. The efficacy of our virus, of our meds are getting better, vaccines are getting better, treatments are getting better. The world now, on average, is handling the virus better, and as a result, that shows up in our mobility business. I think the second factor for us is the delivery business is now bigger than mobility. When we went into the pandemic, the delivery business was about a quarter the size of the mobility business, wasn't yet profitable. And one of the new, I would say, trends that we pointed out to our investors is that we actually expect delivery incremental profits to be at or above our long-term margin targets of 5%. So not only do you have a delivery business that's bigger than mobility, it's a profitable business that's going to push incremental profits. So we're now an all-weather company. And I couldn't say that coming into the pre-virus, but now post-COVID, we're an all-weather company, and I think we can succeed and grow really in any environment.
All right, of course, that was Uber CEO Dara Khosrowshahi. I always say it wrong. Khosrowshahi.
Dara Khosrowshahi.
Thank you, Dara Khosrowshahi. Okay, thank you very much. And of course, speaking with Bloomberg Technologies, Emily Chang. But I think it's pretty interesting what he said about delivery versus mobility. That's pretty significant.
Look, that's really significant for a couple of reasons. One is it's obviously a growing part of Uber's business, but two, what does that say about competitor Lyft? Because Lyft doesn't necessarily have that part of the business.
Yeah, exactly, right?
Right.
And you do wonder what that means. I mean, Uber shares, they're down about 26% so far this year, but we have seen them moving up in today's session. I know he did also an event with UBS last week and made some upbeat comments, and we saw the stock certainly getting a bump earlier on that news, and then just getting some interesting headlines, of course, out of Emily's interview.
You can see more from that interview on Bloomberg Technology. It airs today at 5 p.m. Wall Street time on Bloomberg Television.
All right, you are listening to Bloomberg Business Week. Lots more to come. Watching the markets, and also about that Fed two-day meeting. What's interesting is the Fed has a dual mandate when it watches inflation, higher prices, and of course the labor market. But it's getting a little sticky to keep both of them. We're going to talk about that in just a moment, right here on Bloomberg. And you are listening to Bloomberg Business Week right here on Bloomberg Radio. Carol Master along with Tim Stanovic. And one story that really caught our attention, this is among our most read on the Bloomberg terminal, remaining that way really throughout the day. It's about Wall Street bonuses.
Ah, yes.
And what's interesting, too, is, listen, first of all, you and I, we kind of joke, but when there's a bonus story on the terminal, it always trends high. And this one, as we said, the most read. The two Wall Street investment banking titans dominating this year's deal-making frenzy. And we should point out M&A is on for a record year this year. Well, they're opening up their wallets to try to keep their bankers happy. They're ratcheting up pressure on others, their rivals, to follow suit. We're talking about bonuses.
Yeah, we are. Goldman, JP Morgan are planning bumper bonuses to get an edge in the deal boom. Goldman may boost its bonus pool for investment banking by about 50%. Carol, JP Morgan, as you mentioned, may reach for a 40% increase. This is according to people with knowledge of the initial deliberations. The business, which covers M&A advisory as well as underwriting groups, it's poised for the biggest windfalls after recent meetings to set pay for the year, the people said, asking not to be named, discussing internal talks.
So we know, we've talked about this, if you look around Wall Street, bosses really under mounting pressure to be more generous after tempering raises at the end of 2020 amid concerns that a surge in business set off by the pandemic might not last. There were some concerns, but we have seen M&A on a tear, and it comes in so many different forms. It's companies buying other companies. It's SPACs being on either side of that, proposition. It's IPOs. So it covers a lot of areas, and it's been really busy on that front.
Okay, so let's check out these numbers from Goldman. So the banking group is led by Dan Deese and Jim Esposito. It posted a 63% jump in revenue in the first 9 months of the year. That's versus the same period last year. That helped push the company's total revenue and profit beyond any level it's ever achieved in a full year, Carol.
It's remarkable.
It's remarkable.
And this is one of the things that certainly has been a big conversation throughout the pandemic. And as we increasingly, cross your fingers, come out of it, is the ability for Wall Street to continue to do a bunch of deals.
What happens to SPACs, though, next year?
Yeah, we've seen them before. We've seen waves of them before. We've seen them fall off. So we shall see. But nonetheless, M&A is certainly on a tear.
headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pelletta. Down day for big technology. The Dow, the S&P, NASDAQ all slumping. We are off session lows, but still red on the screen. Right to the numbers with the S&P down 40, a drop now of 0.9%. The Dow down 100, lower by 0.3. NASDAQ down 213, a drop there of 1.4%. 10-year down 6/30 seconds. 10-year yield right now 1.43%. Another jump in inflation, adding more pressure on the Federal Reserve. We get the outcome of the two-day meeting tomorrow, 2 o'clock Wall Street time, and of course, complete coverage on Bloomberg Radio and television. Gold down 0.8%, 17.72 the ounce. Bitcoin slump higher now, turning around up 0.1%, 46,882 on Bitcoin. West Texas Intermediate crude down 1%, 70.61 a barrel. The coffee giant Starbucks has ordered a full inspection of every branch in China after undercover reporters discovered staff in 2 of its outlets using expired ingredients. Starbucks shares lower today by 0.8%. I'm Charlie Pellett. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. We know you know the Fed has a dual mandate, keep inflation in check and also reach maximum employment. The thing is, that's not so easy to do, especially if Fed Chair Jay Powell sticks to his plan of max employment for all, Tim.
There's also this element of modifiers, broad-based and inclusive. Matthew Boesler writes all about it. He's Federal Reserve reporter at Bloomberg News. His story is featured in the upcoming issue of Bloomberg Businessweek magazine. You can read it now on the Bloomberg terminal and at Bloomberg.com/businessweek. Joel Weber is editor at Bloomberg Businessweek. He's with us in the Bloomberg Interactive Broker studio. This was a perfect story for today as we think about what's going on with the Fed, Joel. But it also includes so many parts of the questions that we've been asking, which are really what is full employment today, and how does the Fed define that?
Big time, and we're gonna, this being kind of Fed week here at Bloomberg, and everywhere. Well, we will find out more soon enough. Not a job that I would want, and we'll see how Jay Powell navigates it. So Matt, what's on your list? What are the things that we're all going to be watching for?
Yeah, so, speaking broadly about the meeting tomorrow, Joel, the two big things that we're expecting are for the Fed to accelerate the wind down of its bond buying program and, look to conclude that by the end of the first quarter of next year, and then also signal more interest rate increases in the forecast for next year than they had previously been signaling. And of course, those two things are linked. If they wind down the bond buying program earlier, then that clears the deck for earlier interest rate increases. And of course, this is all coming at a time when inflation has accelerated over the last few months to the highest levels in nearly 40 years. And the Fed is facing a lot of political pressure from both sides of the aisle to do something about it.
You mentioned the inflation word there, and I'm wondering how that runs into inclusive employment and the dual mandate for that matter. Like, how has that changed the conversation from just a couple months ago?
Well, yeah, it's really interesting because if you go back to last year, we were kind of in the middle of a national reckoning on race, right, with both the pandemic and, of course, the killing of George Floyd that led to protests across the country against police brutality. And a lot of institutions came out and made pledges, to do their part to try to fix this. And for the Fed's part, its pledge was to consider racial disparities in the labor market when it's trying to make its assessments of how close the economy is to maximum employment and therefore, what to do with interest rates. And so that was clearly top of mind a year ago. And like you said, the Fed has two mandates. Now, obviously, inflation is kind of taking center stage politically. And the Fed, isn't necessarily, getting that sort of prodding from Democrats on the employment issue that it was a year ago. And so this has become less of a partisan debate. Should the Fed prioritize employment broad-based or should it prioritize inflation? You've kind of got both sides wanting it to deal with inflation first and foremost, just the way the political winds are shifting behind it.
So is there a chance, Matt, that the Fed won't be able to achieve its goal of broad-based and inclusive And what do we know about the definition of broad-based and inclusive? Because you run through some numbers here that show that there's a long way to go when it comes to certain parts of the American population getting back to work.
Right. So this is the most interesting part, right? Because, a layperson might say, well, broad-based and inclusive employment, maybe that means the black and the white unemployment rates are equal, and there isn't this big gap between them like exists now, right? Black unemployment is 6.7%, white unemployment is 3.7%. That doesn't obviously meet, a layperson's definition of broad-based and inclusive, but the Fed has been very careful not to put numbers on this, not to define what they mean. And so when it comes to this question of, will they be able to meet their goal of broad-based and inclusive employment, what we're kind of seeing is they've got plenty of latitude that they've given themselves to sort of redefine that goal. And that's kind of what people are increasingly expecting them to do, if not tomorrow, then in the coming months, as inflation increasingly becomes a bigger priority.
It's one of those things you do wonder, right? You figure out, you do your modeling, because you ask in your story, Matt, how much more could the black-white unemployment gap narrow if the economy were allowed to run hot for longer, right? We just don't know, and it would have to be an experiment in real time, and maybe the gap does get reduced and things do improve for black unemployment. Maybe it doesn't.
Yeah, and this is another great aspect of this whole conversation, because the Fed has essentially thrust itself into this very long-running political debate in America over what are the true causes of this, right? On one side, going back decades and decades, it's always been about education. We need to, expand educational opportunities and job training for these underserved communities and, position them to succeed better in the workforce. The other side has often said, well, no, it's really not about, training for these jobs. It's about, are these jobs available in the first place? And so that kind of gets to this question of, is the answer not just the government needs to spend more money via fiscal policy, the Federal Reserve needs to run the economy hotter via monetary policy, and these things are going to start to sort themselves out on their own in the private sector labor markets. And we got a little bit of a taste of that, before the pandemic, in the years leading up to it, with the unemployment rate getting so low. You did see employers starting to increasingly hire into these, underserved communities, tap into these labor pools, and you started to see some movement there. But of course, it was truncated by the pandemic. And so in some sense, what a lot of people want is to kind of get back to that place where we can at least get back to running that experiment. But in the meantime, we've got some other issues to deal with that are still being driven by the pandemic, perhaps, like inflation.
Genuine question. How many balls can Jay Powell juggle at one moment in time?
That's a great question. Hopefully at least two, because that's the Fed's job. But it does,
I think even I can juggle two balls. Is that juggling?
Let's give him like four more and see what happens.
Hey, I just wanted to end, Matt, very briefly with talking about the idea of looking at some other metrics here, because you spoke to David Wilcox here at Bloomberg Economics. He heads U.S. economic research for Bloomberg Economics. What about the other data that we get, just in about 30 seconds?
Sure. So, a lot of people are pointing to job openings, fast wage growth, and, survey measures that suggest the labor market is very tight. This is really interesting rerun of the conversation we had in the wake of the Great Recession in the years like 2009 and 2010. So it's kind of following a similar pattern, even though the circumstances are very different.
Who wants to change places with Jay Powell?
No.
Raise your hand.
No way.
Nobody's raising their hand. Matt Boesler, thank you so much. Matt Boesler is Federal Reserve reporter at Bloomberg News, joining us on the phone from New York City. Check out his story. It's going to be featured in the upcoming issue of Bloomberg Businessweek magazine. You can read it now on the Bloomberg terminal, also at bloomberg.com/businessweek. It's tricky. It's tricky, especially when there's so many questions out there in the economy.
By the way, Matt's going to be, I assume, watching closely tomorrow and perhaps asking a question or two.
Nah, he's on a plane headed to Mexico, I think.
Don't think so.
Isn't everybody going to Mexico right now? Joel Weber, of course, the editor of Bloomberg Businessweek. He's in our studio. All right, stick around. You're listening to Bloomberg Radio.
This is the countdown to the close. 60 minutes left in the trading session here on this Tuesday afternoon. Romaine Bostic alongside Taylor Riggs and Kaylee Lines in for Caroline Hyde. We're joined right now by our colleagues in the radio booth, Carol Masser and Tim Stenovic, together bringing in full our Bloomberg audiences across TV, radio, and YouTube. And Carol, we're 60 minutes away from the close and quite frankly, less than 24 hours away from what a lot of people see as a very pivotal Fed decision.
Yeah, I think that's the way you need to characterize it. I think this is we've talked about it before, a tough time for the Fed to be making a decision. Here we are watching, concerns about this variant. We don't know what that's going to mean in terms of an economic slowdown. What I do find fascinating is that maybe the volume isn't potentially there in today's trade, but we are seeing a fair amount of selling. Typically, I feel like momentum slows down before a Fed decision, Tim, and we're not necessarily seeing that.
Yeah, especially when it comes to those mega cap tech stocks. That's what I got my eye on, at least when it comes to the equity trade today. You see that playing out with the underperformance of the NASDAQ 100 and the NASDAQ Composite with companies like Microsoft having a really bad day today for really no fundamental news.
Yeah, definitely a soft day here. We should point out volume only about 5% below what we would normally have, but typically the setup into these Fed meetings, you definitely see a little bit of a pullback both in terms of volume and trading activity, and you're seeing it in prices here. The S&P 500 at one point was flirting with going below that 4,600 mark, 46.29 right now, down about 0.8%. Dow Jones Industrial Average down 0.2%. The NASDAQ Composite back now firmly below that 50-day moving average at 15,202, down about 1.3% on the day. Russell 2000 down 0.8%.
Well, and you see that big tech underperformance when you look beneath the surface of the S&P 500. Look at things from a sector level. It is information technology that is down the most, down nearly 2 full percentage points at this point. Consumer discretionary also near the bottom of the barrel. Of course, that is primarily composed of Tesla and Amazon, other what we would classify as big tech stocks. Interesting, the only sector of the 11 major industry groups today that is in positive territory is financials, up about 0.75%. That probably has to do with something that we're seeing yields moving up just a little bit today.
Yeah, that's the bright spot on a sector basis. When you look at the individual movers out there are a couple of bright spots there. Pfizer up about 0.6%. Uber up almost 5% here on the day. Apparently, Dara Khosrowshahi had a fireside chat at UBS. I don't know exactly what fireside chats are or whether there was actually a fireplace there, but he gave some interesting commentary about the company's prospects. Investors seem to like what they hear. Still on Apple Watch, of course, moving in the opposite direction of that $3 trillion market cap, despite the fact it got a street high price target, another street high price target over at Bank of America. And then an interesting story here out of California. Enphase Energy, Sunrun, all of the solar energy stocks really taking it hard today. California actually moving forward here with new rules that effectively remove some of the subsidies that allowed people to sort of install some of these roofs without at a slightly lower cost here. This still has a ways to go before it actually becomes enshrined in regulation and in law, but a lot of people say this is going to be kind of the beginning of the end, I guess, for a highly subsidized industry out there.
And yet, I hate to be the one to do it, it always comes back down to the Federal Reserve in one way or another as we go micro back out to macro. And Carol, for the radio audience, we'll make sure to tweet this out, but basically what we're looking at is sort of the rate hikes and what's expected. And I think what's really interesting is that a faster taper doesn't necessarily translate into more rate hikes. You're still only pricing maybe 1 by June, 3 then by December of next year. But it was Steve Englander over at SocGen saying that investors, even though they're pricing in, you're not pricing in anything by 2025. So what does that mean really here going forward? And then once you get through next year, what about the next 2 years? And that's really where some of the uncertainty comes in.
And this is where, listen, we know it's going to be very important what we get from the Fed and all of the central banks, the ECB on Thursday, what they have to say about the outlook. In the meantime, anytime a CEO speaks to us, and the Uber CEO caught up with Emily Chang, an exclusive interview, what they have to say about the outlook, what their business says, gives us a lot of information. Check it out, everyone.
I do think that the price of Uber is going to be higher than it was, similar to the price of everything right now, frankly. But we are working, as we improve supply and demand balances, prices will naturally come down, which we think is a good thing for consumers, and it's a good thing for us as a business, too.
And that's Dara Khosrowshahi, of course, the Uber CEO. So we look for information about what they're seeing about their business, and hopefully that helps us piece together the puzzle. I hate to keep talking about earnings because they're a month away, but that will be really important.
Well, look, I think Uber's a great company to talk about when we think about inflation, because if there is something that consumers notice, it's when the price of rides go up. We knew earlier in the year the price of rides was going up because they were having trouble actually getting drivers back on the platform and getting back out there as the pandemic continued to rage. But think about the cost of fuel and the way the cost of of fuel has gone up. So it absolutely makes sense when you think about Uber's business model that the company will have to raise prices.
All right. Well, at some point, I mean, we have to talk about these producer price numbers because, I mean, when you talk about inflation, you have to talk about the pipeline that feeds into that consumer price inflation. Of course, it is a lot of the wage growth. It is a lot of the supply chain costs that we talk about here on the show. The costs that a lot of these companies, to a certain extent, have basically borne. They've basically shouldered it themselves, but we're starting to see more and more of these companies start to talk about passing those costs along. We saw that to a certain extent with Uber. They sort of tried to, anybody who's tried to book an Uber knows they've tried to pass along some of those higher wage costs on to people like you and me.
And you really talk about the pipeline of that. These numbers are astounding, Kaylee. Intermediate processed goods prices up 24% year over year. Unprocessed goods prices, so the step ahead of that, up 30% year over year. So it doesn't show signs of slowing down either. So when have we peaked?
Well, it's an excellent question. I think you'll find different answers depending on who you talk to. But the point is, we're talking about big numbers. And as Romain pointed out, a lot of this has been supply side driven, supply shortages that monetary policy, frankly, isn't in a position to fix. So the Fed's not going to fix the supply issues. What it can do is hit demand. And then what is the implication for that when we think about growth moving forward in the normalization of policy?
So buying bonds doesn't get the boat off the ocean?
Exactly.
I didn't know that.
Well, but is this too, I mean, is this one reason why maybe we did not see more of an acknowledgement by the Fed of these issues? It's not that they didn't know that it was supply chain issues, supply side issues. It was that they didn't really have an effective response. So let's just focus on the demand side, and then we'll, I guess, somehow reconcile the two at some point.
They can't do too much about it. Did you guys see the ECB new projections that came out? I mean, we're going to know officially Thursday where they stand, but they see inflation below that 2% target going into 2023, 2024. That's a long ways, away. But I do wonder, the big question is, as quickly as inflation shot up, can it drop down? And that's going to be one of the great big questions of our time.
Well, just real quickly, Carol, I mean, you're seeing that in the U.S., at least as priced in with U.S. break-evens, you're seeing those numbers start to come down. So at least some folks do believe that is the case.
Yeah, exactly.
One thing that I'm still thinking about is the idea of the pace of goods, the idea of the goods growth, right? The price of goods still outpacing services, and what that says about the way Americans are still buying those things that we were buying during the pandemic more so than actual services.
Sorry, I think we're all distracted here by this headline. Gwyneth Paltrow-backed crypto miner TerraWolf falls in debut.
Are you a Goop user? You seem like a Goop user.
I love me some Gwyneth Paltrow.
Carol, say
Hey, who doesn't love Gwyneth Paltrow?
Who doesn't?
All right, we got to
Now
run,
she's
folks.
backing crypto mining? What's not to love?
She is everywhere. All right, we got to do it, folks. That's going to do it for now. We'll see you back, though, for Beyond the Bell, our cross-platform coverage on TV, on radio, on YouTube. We're going to be counting you down through that market close and maybe mentioning maybe a little bit more on Gwyneth. All right, folks. This is
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
I was thinking about in our Fed discussion there with our TV colleagues, Tim, that what we just talked about with Matt Boesler, this story that's going to be in the upcoming issue of Bloomberg Business Week. You know, Jay Powell and other Fed colleagues have talked about the importance of when we see the employment picture improve, it's got to be inclusive. So can they stick to it? There's a lot of moving parts that they have a dual mandate, but a lot of things as you branch out that they're going to be looking at. And I think it makes it difficult and a more complicated decision-making process when it comes to tomorrow's decision.
One thing that I've been thinking about is the type of question that I would ask.
What would you ask?
The Fed chair. You know, I want to ask about metrics and the type of data. Because you've talked about this a lot over the last year, Carol. What does full employment look like? When we see where the participation rate is right now, when we see the number of Americans who still are not back in the labor force, what else should we be looking at to indicate that the economy is or is not healthy?
And that we're at full employment or not?
Exactly.
I agree with you. It's tricky, and we've had some great conversations with Kathleen Hayes and some others in the newsroom, Mike McKee, about people who maybe left the workforce. So maybe labor participation isn't going to go back to where it was. It's just like home ownership. You know, we thought about it, we rethought about it after the financial crisis. Should everybody be owning a home, and were those rates the rates they should be? So I do wonder how much of a reassessment, recalibration, I'm going to say that word again, that we need to be thinking about certainly here.
Well, we're going to be talking with Steve Skanke, Chief Economic Advisor at Keelpoint, in a few minutes, all about what's going on tomorrow.
Yeah, exactly. You are listening to Bloomberg Radio, and what's interesting, too, is, you know, I am curious to see what Steve has to say about that dual mandate and what needs to be really front and center when it comes to Jay Powell and what they're thinking about in the economy. Or do they need to say, hey, folks, we need a little bit more time. We're going to need another month's worth of data to get a better understanding. And maybe to hear from some of those CEOs
right.
when it comes to earnings and the outlook to understand what's going on in the economy.
So what would be the first indication then? And again, this might be a better question for Dr. Stephen Skanke in
Much
a few
smarter
minutes.
than me.
But what would be the best indication that we've peaked when it comes to inflation, that we know that prices are going to start coming down?
Well, I think you look at producer prices.
Well, that didn't happen today.
No, exactly. That's November data. Like I always think about, you know, what this data is. I think you really have to be smart about looking at trend lines. One data point never tells us anything, but what are the trend lines? You know, I do find it interesting that there's a lot of things I go to buy and they're on the shelves. Like I go to gas stations, there's gas. So it's not like what we saw, you know, back in the 1970s, right, when there were odd and even license plates in terms of who could get gas. It wasn't those higher rates. So it's, I think, different this time around. So, I don't know what we look at. And this is where I enjoy those conversations with CEOs about leaders, like what's really tripping it up. We even talk about semiconductors, right? That
Well,
there's maybe
it's that,
some easing.
I think also perhaps has to do with some alternative data. We talked to Ed Ludlow, gosh, it was last week that he was at the Port of LA, right? And the number of ships is still really high. They're queued to unload their containers there. So that crunch that we're seeing there is still remains.
All right, well, coming up is Steve Skanke over at Keelpoint, so we'll see what he has to say about the Fed and monetary policy. That's coming up next on Bloomberg. All right, folks, you are listening to Bloomberg Business Week. Carol Massar along with Tim Stenovec. And catching our attention is, I mentioned this in our chat with our TV colleagues, because I think this is interesting. With the EC coming out, the European Central Bank's new projections showing inflation below the 2% target in both 2023 and 2024. So that's long term. That's over a year from now. This is according to officials familiar with the matter. And that would, give President Christine Lagarde some ammunition to argue against a swift increase in interest rates.
I got to tell you.
I love when you laugh like this.
Well, I got to tell you, I think that we can't divorce the political aspect here because we live in a political world and we live in a political country. And because the Democrats are in power, they're certainly bearing the brunt of the rising prices. But look no further than around the world at the way that inflation is affecting other countries.
Were you shopping for a Chanel bag recently?
Yeah, is that where you're going with this? But I do think it's important to keep in mind it's not just the Federal Reserve and it's not just inflation here in the United States. It's something that the European Central Bank is trying to get under control, and other policymakers as well.
We talked about this with Tom Orlick,
Yeah.
like the diversion that we will see potentially when it becomes to U.S. central bank policy versus Chinese central bank policy. Like, what does that mean in terms of financial markets? What does that mean in terms of, currencies? There's a lot of things. You're reading the Chanel story.
I'm reading the Chanel story.
All right, so let's just go there. Even during the deepest depths of the pandemic, you wouldn't see people in South Korea hoarding steaks, toilet paper, or pet food. Instead, they developed another new habit, waiting on lines outside department stores beginning at 5 a.m. to buy items like a $9,500 Chanel purse.
That's a lot of money. The so-called open run, it's a freestyle sprint to buy goods as soon as the stores open. It began last year after shoppers tried to beat a price increase by the French brand Hello Inflation Expectations. It has since expanded to include other designers as well.
And this goes to the haves and the have-nots. And this is another thing. Like, you wonder how much the Fed is looking at wealth creation, the sharing of wealth, which we haven't necessarily seen here, and you wonder how that will come up, certainly in the Fed decision, but more importantly in some of the Q&A later on. All right, we're going to check in with Steve Skanke in just a moment. This is Bloomberg.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. Big tech tumbles. It is a down day, but key takeaway, we are off session lows. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. Like you said, stocks in the red, but off their worst levels. Dow's now down 69 points. S&P's dropped 33. NASDAQ still lower by 176. The U.S. 10-year yield at 1.44%. Gold is down 14 points. Oil is also trading lower, but Bitcoin is trading higher by 0.6%. Among the main 11 S&P sectors, only financials were in the green, and leaders to the upside in the Dow, Travelers, Goldman Sachs, and Merck, while Salesforce, Microsoft, and Cisco led to the downside. In deal news, 3M is merging its food safety unit with Neogen in a $9.3 billion deal. And in U.S. politics, Democrats seek to increase the debt limit by $2.5 trillion. In other news, Uber is looking to sell Didi and other non-strategic assets. The Ford CEO says there's a lot of upside and don't sell Ford stock. And Apple to again require masks at all their U.S. retail stores. Wrapping things up, Skillsoft reports after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie.
Okay, we thank you very much, Bill. And to hear live breaking news over your Bloomberg Type Squawk as QUAWK on your terminal, I'm Charlie Pellet. That is a Bloomberg Business Flash.
So we're just under 23 hours away from the last Fed decision of the year. I am.
You really are.
It's like 60 minutes. That's what we're doing. Probably not an easy one for the U.S. Central Bank this time around, considering the long list of uncertainties and questions and really pressures that face Fed Chair Jay Powell and company. So we thought we would get a strategy play on the Fed. We have the perfect go-to voice for this.
It's Dr. Stephen Skanke. He's Chief Economic Advisor at Keel Point, also former U.S. Treasury and White House National Security Council staff member. He is with us after, a 2-year break since we've seen him in the Bloomberg Interactive Broker Studios. It is really great to have you with us, Dr. Skanke. How are you?
I'm great, thanks, and it's wonderful to be back here. It's exciting to be back in your studio.
Okay, so tell us right now what the Federal Reserve officials are thinking. What's going through the mind of Jay Powell?
They're trying to figure out how they're going to lay this out in an effective way that doesn't spook the markets, restores confidence, and shows that they're not behind the curve.
Is that possible?
I think it is. I mean, it's a big challenge. The good news is that Jay Powell had a very bad experience in December of 2018,
right,
when he badly miscommunicated to the market, and he understands the response, and that was about taper and reducing liquidity in the economy. And so he gets that and how sensitive the market is to that. And so that's what we're talking about for tomorrow, speeding up the rate of taper, probably ending it by the end of March, so they have plenty of room then to do whatever they want to do about interest rates.
All right, so help me out here. Price stability, full employment or maximum employment, no market tantrums. That's not part of their mandate.
The third thing you said, Carol, it's not a triple mandate, right?
Exactly, but they do keep a close watch on the markets.
Oh, absolutely, because it spills over into the economy.
Yeah.
It affects consumer confidence, business confidence, and we actually got some good news this morning with the Small Business Optimism Index.
I'm so glad you brought that up. Tell me, talk to us about this, because small business, right, backbone of our economy. What did you glean from that report?
Well, to be honest, I was surprised because these small businesses are on the receiving end of higher costs for services, higher costs for intermediate goods in their production. You saw the producer price index out this morning, up 9.6% for final demand. Big impact on small business, and yet they came out with a moderate increase in their optimism. That's very encouraging. They're also on the hiring end, and so they're very much affected negatively by all the unfilled jobs as they're trying to expand and build their businesses. And we know that for every job that's available, there's less than one person available to fill that job.
So does the information that we're getting, and I think that small business optimism report was a big one too, I agree with you, does it give the Fed you talk about the importance of their messaging and how they put it out there, Steve. Does it give them more room to be a little bit more hawkish, or do they just stay the course at this point, from what we last heard from Jay Powell when he was really up before congressional lawmakers?
They are going to be more hawkish. They
will.
want to come across as more hawkish, but they don't want to sound panicked. And so the Small Business Optimism Index, that helps. Consumer confidence from the Michigan survey earlier this week is up a little bit. That also takes away some of the anxiety and fear in what they're doing. So it gives them some breathing space. Also, energy prices are down some, food prices are down some. It makes it easier for them to be hawkish without looking like they're way behind the curve and scrambling to catch up.
What do you think is baked in as far as expectations go? You did say that you expect to see tapering probably ending by the end of March. What spooks the market, though, tomorrow?
What spooks the market if they get something that doesn't look like that?
Yeah.
Number one, if the Fed doesn't change the rate of taper from $15 billion a month to say 30, which would get them finished up by the end of March, then they look like they're out of touch.
Right.
If they try to do something too much, or if they actually talk about their target for raising interest rates in 2022, that would spook the market.
Right. So all of a sudden they said, okay, hey, we're thinking maybe in June or something, right?
Exactly.
Or whatever.
Because that sounds scrambling, sounds desperate. And if they can just be out there and say, hey, look, Powell set the stage with his November 30 testimony. If he can just follow up with that, and remember we talked about the minutes a couple of weeks ago, they are ready to increase the rate of taper. So if they just go along with that, and it sounds business as usual, we are on course, we understand where it is, we're comfortable with that, market will love it. Doesn't mean it won't sell off some, but it's not going to be a panic.
This will be the first meeting and the first time we hear Jay Powell questioned by journalists who cover him since he essentially banned the word transitory or said that that's not a term we should use anymore. Is there anything about what he says about inflation that could spook people? The idea that it has become something that is more persistent, or do we know that with all the data that we've been getting?
I think he put that out on the table on November 30. Now, since then, we've had the November CPI, 6.8, and the November PPI producer price index at 9.6. So those higher numbers are out there, but he's already been clear.
Well, I like, David Weston talking with Brian Moynihan, CEO of Bank of America, saying, come on, folks, we know that there's inflation out there. How possible is it, Steve? I mean, if you think about the last year and a half or since the pandemic started, right, the economy shut down, right? And then all of a sudden, we came back as things started to reopen and we found our way. We saw that inflation take off. How likely is it possible that all of a sudden inflation, as more people come back to work or supply chains start to get more normal, that inflation drops again? Could we see a quick drop like that?
Absolutely. And in fact, we will see inflation drop just from the energy prices coming down. That'll have an impact on December inflation numbers that come out in January as people come back to work. Depending on what China does, is it going to double down on the Omicron variant, or is it going to continue to increase production? That's a huge part of the supply chain, and if they really tighten up there, that'll just exacerbate the problem we have with prices here.
So if Jay Powell comes out and said, listen, folks, we know inflation's going to get back to a much more normalized rate. I mean, I think he's talked about that already. Like, we get that. Will the markets respect that if he says this is why we have to continue to go slowly, because we're not necessarily looking at normalized rates yet?
I think that they will, and what helps so much is that we're going to see GDP growth in the fourth quarter somewhere in the 6.5% to 8.5% range.
It's like China.
I know the New York Fed is still projecting fourth quarter GDP growth of annualized rate of 8.4%. And we probably have 6 to 6.5% baked in for 2021. So you've got that out there, and that, of course, drives top line revenue, drops to the bottom line. Companies have been able to pass along prices well enough that there's not really an earnings squeeze going on, or not much of a material one.
Right.
So we're going to turn in record fourth quarter quarter earnings reports again in January that will just continue to buoy the market.
So why do I feel like I'm living a dream or like a weird? Why does it feel so bizarro world?
Well, because it could make a surprise negative turn. That is the real.
Is it too early to use the R word?
I think it's too early to use the R word. But if we had a really negative development on the COVID front, that certainly could be the case. If other countries shut down production again, it almost doesn't matter what we're trying to do in the United States because of the supply chain and the impact on prices and the impact on production and employment here. We could certainly move in that direction. That's the worry.
We're going to keep you for another 30 minutes.
No, you're not going anywhere. Put your seatbelt on. I'm wondering, Dr. Skanke, about the how the labor market sorts itself out, because Carol described it as this bizarro world, right? It's this idea that, you know, there are not enough people for the jobs that we have available. Our companies are somewhat raising wages to try to attract and retain people. But where does the Fed come in and actually trying to resolve this, and how can they resolve this?
Well, the Fed has a conundrum because they really wanted to see unemployment far below where it is right now.
Yeah.
They wanted to see it back down at 3.5%, which is how you get the broad distribution of jobs to the minority and disaffected labor groups.
This is the broad and inclusive part of the mandate that
That's
they've
exactly
included.
right, and that's very hard. And it sort of begs the question of their credibility if you're having 8% GDP growth in the fourth quarter, 6% to 6.5% for all of the year.
Right.
And then you've got inflation out here at, pick your number, whether it's personal consumption core or CPI headline, it's in the range of 6+%. So they can't lose credibility by ignoring that reality with robust economic growth and a phenomenon within the labor force of just people not coming back.
And yet, we every day here at Bloomberg, and I really commend our team here because are very smart about reminding us of the gaps that are out there. And if you're in, Tim and I laugh about, you're looking at your 401k because it's been a remarkable couple of years. Yet there are people who are barely making it or not making it at all. So what's the Fed's responsibility to that? And just got about 45 seconds or so.
Well, the Fed certainly wants to address that. But they've got this tough balancing act of how do they do that effectively when you've got inflation above expectations developing to be a problem and not wanting to look like you're behind the curve. So they're more likely to err on putting on the brakes a little too much, a little too soon, than they are to wait and let it get out of control. And that'll be the really interesting question as to what they announce tomorrow and how Jay Powell fields the press questions.
20 seconds, what would you ask Jay Powell at that press conference? Pressure's on, Steve.
Where are you happy with the unemployment rate and the distribution of jobs? And why do you think that we continue to have so many less jobs and less participation in the labor force in what is really a robust economic growth cycle?
It's the question it's like spot on. It's so agree. Thank you so much. What a delight.
Thank you.
Really great to have you in studio and just be here. Dr. Steve Skanke, Chief Economic Advisor at Keel Point, former U.S. Treasury and White House National Security Council staff member, based in Washington, but he made his way to our Interactive Broker studio. Thank you so much.
Well, we are less than a half hour away from the market close. Let's get an update on that trading day. Here's Charlie Pellet.
Thank you very much, Tim. We are well off session lows right now. We have got 28 minutes to go before that closing bell clangs, and right now the S&P down 25, narrowing its loss, still down by 0.5%. The Dow is down 35, right to the numbers, down by about 0.1%. NASDAQ, meanwhile, paring its loss to 128, down by about 0.8%. The NASDAQ 100 index also down 0.8%. As the Fed gets ready to wrap up its final meeting of the year, another report showing inflation running hot sank some of the most expensive pockets of the stock market. The 10-year yield right now, 1.43%. Spot gold is down 0.8%, $17.71 the ounce. West Texas Intermediate crude down 1%, $70.54 barrel on WTI. Bitcoin bouncing back, now up 0.8%, 47,216 on Bitcoin. South African studies show Pfizer and BioNTech's COVID-19 vaccine, as well as the shot developed by Johnson & Johnson, appear to prevent severe disease from the Omicron variant. Discovery Health, the country's largest medical insurance provider, says the two-shot Pfizer course may offer 70% protection against being hospitalized with a variant that is driving that country's fourth wave of infections. As for what those studies might suggest about getting us out of the pandemic, Dr. Amish Adalja, senior scholar at the Johns Hopkins Center for Health Security.
It does seem that for the unvaccinated, it still might be just the same as Delta, and we may be trading Delta for Omicron. But if it's more transmissible, but even just a little bit less virulent, it may end up being a wash overall for what we're dealing with. So it all depends on how this all plays out in the U.S.
Dr. Adalja with the Johns Hopkins Bloomberg School of Public Health, which is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Checking some of the vaccine names that we follow for you, we track every day at this time. Pfizer up 0.6%. Its German partner BioNTech, the ADR is down 0.5%. AstraZeneca up 0.1%. Moderna higher now by 2.1%. J&J Johnson & Johnson up by 1.2%. JP Morgan Chase will require vaccines to enter 9 Manhattan office buildings, including its headquarters at 383 Madison Avenue. Apple is reinstating its mask mandate at U.S. retail locations and will proactively limit store occupancy. Apple shares down now by 0.2%. And New York State's Ethics Commission has voted to require former Governor Andrew Cuomo to repay the more than $5 million in compensation he got for a book he wrote in 2020 on his handling of the COVID-19 pandemic. Recapping, 10-year yield 1.43%, S&P down 24, down 0.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, we are just under, a little over 25 minutes away from the market close. It's time now for Kriti Gupta's Chart of the Day. She's Bloomberg Markets correspondent here at Bloomberg News, and she's with us once again in the Bloomberg Interactive Broker Studio. Today, your Chart of the Day focuses a little bit on energy.
On energy, on oil markets. You know, we've been talking so much about, is the Omicron variant going to affect the economy, or are we going to be okay? Is the booster campaign going to kind of offset it? And for a while,
the booster campaign, and also just like we know what to do now.
Yeah, we do, in infrastructure, but that doesn't necessarily mean that we're 100% there, right? Even if we do go into, say, a lockdown, a worst case scenario, that does still have an economic impact, and most notably through the oil market. Essentially, people stop traveling, they stop driving, they stop commuting to work. So today, my chart of the day is really about what markets are freaking out about this. And to me, I think the oil market is the best read of that kind of economic impact, especially when it comes to the variant in particular. And today was actually great timing because this actually happened a couple hours after my chart kind of talked about this, was this idea of backwardation flipping into contango. Now, for some of our listeners who are not familiar with the intricacies and nerdiness and wonkiness,
there's a couple words there that we don't hear all the time, right?
They're not in the SAT vocab
It's
deck.
something Alex Steele has talked about. She's like so good with this stuff too, right?
She's a genius.
She's incredible.
But let me try to simplify it for you. And Tim, keep me honest here if I'm not able to do that. But essentially, backwardation is the normal state of oil markets, which means you need oil right now to travel, to hop into your car. So traders buy it immediately right now, and then the oil prices for, say, a contract 2 months down the road or 3 months down the road, it's cheaper than it is right now. And you want that to happen because it means the economy is booming, people need that energy right now, and they need that source. But what tends to happen in recessions, it tends to happen in oversupplied situations, when the pandemic first broke out, is it switches to a fancy word called contango, which is essentially that a contract for later on in the time frame, say 2 or 6 months down the road, is far more expensive than now. And that just means that no one was really using the oil now. No one's traveling, no one's commuting, no one's, the economic activity isn't really there. So that's the problem. And so when you start to see that spread narrow and get closer to negative territory, it becomes very concerning, because it means traders are pricing in a situation where demand isn't going to be as strong as it is right now. And that's
Steve
what's been
Skanke was just talking about lower energy prices as we were trying to talk about inflation. And it was part of his kind of the outlook there.
Well, perfect. Well, so since the Omicron variant really become part of the headlines, this spread or this premium has narrowed and narrowed and narrowed. And I'm just looking at this now. It's now at 26 cents between the first month contract and the third month contract. So going into essentially the spring of next year, and it's getting very close to negative. You look at a very closer time spread, the first month to the second month, it actually did turn negative in intraday trading, and then it kind of bounced back into positive territory. But it tells you that the oil market is very clearly pricing in this variant scare.
So when we talk about, Tim, you are so smart about saying like different metrics that we want to find in terms of what it says about the outlook. Could this possibly, does it historically mean that we're getting ready for things to slow down in terms of the economy? And whether it's because of the variant or because of something else.
Yeah, absolutely. And the oil market, like you said, because it is a very direct read of the demand situation and the need on the ground for the economy, some other kind of asset classes tend to take their cue from it as well. So I explained this in my story, folks, check it out. But the S&P 500 tends to take their cue from oil as well, because at the end of the day, it comes back to growth. And if the economy isn't growing, you don't need oil. And if oil freaks out, the stock market tends to as well.
Okay, one more time. All right. What do we want it to look? What do we want the prices to look like?
We want the prices to be more expensive now, cheaper down the road for oil prices. And that's a good thing. Backwardation.
All right. There we go.
There'll be a test. But maybe it might be on the Bloomberg quiz this week.
Oh,
coming
well,
out
I got that one
Thursday.
right.
Hey, just quickly, what else is on your radar?
Yeah, we got to talk about supply chains. We got to talk about the switch, especially when we're talking about inflation and supply chain snags. The latest kind of transition is folks saying a shorter supply chain is a stronger supply chain. So a lot of production that was extending over into Asia is actually moving to as close as Mexico. The idea is
localization kind of thing?
Essentially.
To some extent.
This is exactly what I was going to bring up when we were talking to Steve Skanke. Because he said if we have worst case scenario, and perhaps this variant or another variant, like some sort of surprise when it comes to COVID, and we see supply chains and get even more snarled, right? Factories shut down overseas, then that's a huge issue.
It's a huge issue, and you can see a lot of these companies had already kind of made the pivot during the Trump administration. Right. They'd already said trade war's coming, we got to pivot, and then during the pandemic, that just amplified.
So nearshoring, is that what we're calling it?
Sort of. For now, it's just called an economic boom in Mexico along the U.S.-Mexico border. But
that's what I wonder. Like, how much of it is because, we have relationships, right, with Mexico. It's easy for us. They've got cheap labor. And so it kind of makes sense if we're looking for a lower cost provider, why not take one that's maybe closer?
Yeah, and that there's less risks for. So, for example, in the story that we're looking at today, Supply Chain Hell Ignites Economic Boom Along U.S.-Mexico Border by our very own Thomas Black. He actually points out that one of the major cities dealing with this is El Paso, Texas, because it's so close, or the city next, Juarez, actually, which is kind of the sister city of El Paso, Texas, because it's so close to the consumer. The travel there really works in its favor.
Well, and I think about with ESG, and like as companies get graded on their impact, you are going to be thinking about what does it cost to bring something from thousands of miles away, and maybe this isn't today's story, tomorrow's story, but I do think that's going to be a factor longer term.
And just for some color on the ground, I flew into El Paso a few months ago when I went and saw Jeff Bezos' rocket take off for the first time, carrying people. And you have to understand, El Paso is so close to Juarez. There's like essentially a fence that runs through it, and people can commute back and forth. My cell phone actually thought I was in Mexico for a short period of time. It is literally right there. It goes through the city.
And there are because this is a global issue. There's so many cities around the world who have that. There's a city on the border of Germany and France where folks live in Germany and they go to work in France and they come right back, and that's why those
a lot easier to do
controls.
in the European Union than
very
it is
true.
between the U.S. and Mexico.
Very true, but hey, that could very easily change.
And they do have programs for a kind of fast pass type of thing, so people who do work across border can quickly move across the border.
Does this mean Apple's not going to be manufacturing phones in China?
Maybe one day. We don't know.
They already do some production in India.
All right, Kriti Gupta, thank you so much. You're listening to Bloomberg Business Week. Carol Massar, Tim Stenovic, and this is Bloomberg Radio. All right, you're listening to Bloomberg Business Week. Carol Massar along with Tim Stenovic. An interesting story in the Bloomberg by Ben Steverman and Scott Carpenter. And it says Mark Zuckerberg and Jeff Bezos leading the charge of U.S. billionaires selling shares. This is like the ultimate insider selling stock, but it may not be for questionable reasons. Maybe it's for taxable reasons or the ability to pay taxes.
I mean, who knows when it comes to Elon Musk, right? You have to kind of look at the tweets.
Well, yeah, but we know,
No.
right? Like everybody's, right? Hasn't it been the...
Well, it's
that
not just Elon Musk, okay? So let's
No.
talk a little bit about this because we are getting to the point, we're to the end of the year, we can look back and kind of quantify who's sold what. Mark Zuckerberg sold Meta Platforms stock almost every weekday of this year. The founders of Google began to unload shares in May. That's also when 2 of the 3 Airbnb and co-founders started diversifying their stakes. These transactions, Carol, are part of a surge of selling by the very richest Americans. They unloaded $42.9 billion in stock through the start of December, more than double the $20.2 billion they sold off in all of 2020. This is according to an analysis of transactions by U.S. billionaires. That's on the Bloomberg Billionaires Index. It is a daily ranking of the world's richest 500 people.
Yeah, so, and I get, some of it has to do with often when you hear out of lawmakers changes in tax policy, and so there could be questionable or higher taxes maybe for the wealthier down the road. That's certainly been something that's been, coming up with the, infrastructure program and Build Back Better that's been working its way through Congress. So maybe biting the tax bullet this year may mean avoiding rate hikes in future years. That's what some wealth managers are saying. The other thing which I find interesting is that you have these ultimate insiders selling stocks, and yet Facebook is still up about 23% this year, and Tesla, which has been bouncing around as of late, still up 36% this year. And, typically, often, right, when you see an insider selling, you can see a stock take a little bit of a hit.
Yeah, look,
and we
that's
have
certainly
seen
happened
Tesla
with
come
Tesla.
down.
Yeah, that's happened with Tesla. Well, one expert that Ben and company spoke to said that it's not an exodus from the market. It's just that planners are sitting down with wealthy tech clients to gauge the impact of a surtax and other proposals, and then just calculating how much investments would need to rise to justify holding on to them.
It's an interesting read. So they say. All right, check it out. It's on the Bloomberg terminal, also at Bloomberg.com. You are listening to Bloomberg Radio.
Bloomberg World Headquarters, I'm Charlie Pellet. 13 minutes to go ahead of the closing bell with the Dow, the S&P, NASDAQ 100 index all declining right now, right to the numbers with the S&P down 30, a drop of 0.7%. The Dow down 76, drop of 0.2%. NASDAQ Composite Index down 164, lower now by 1.1%. NASDAQ 100 Index down by 1%. As the Federal Reserve gets ready to wrap up its final meeting of the year, another report today showed inflation running hot. That sank some of the most expensive pockets of the stock market. 10-years down 7/32, 10-year yield 1.43%. Spot gold down 0.9%, $17.70 the ounce. Gold down $16 the ounce. Bitcoin now higher by 1.9%, 47,703 on Bitcoin. West Texas 9%, 47,703 on Bitcoin. West Texas Intermediate crude down 1.2%, 70.44 for a barrel of WTI. Apple, which is coping with a resurgence in COVID-19 cases and the new Omicron variant, is reinstating its mask mandate at U.S. retail locations and will proactively limit store occupancy. Apple shares lower now by 0.6%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. It's 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
President Biden says his Build Back Better plan aims to confront the existential threat of climate change. To that end, the House version of his proposal offers a $7,500 refundable tax credit for most electric vehicles. Consumers can then claim additional credits of up to $5,000, but to qualify for the full write-off, an EV must be manufactured by union workers, assembled in the U.S., and made with American batteries. Here's the thing. Non-union plants, including those run by Tesla, make the vast majority of EVs on U.S. roads. Foreign automakers produce half of the most popular brands. So why exclude the most prominent manufacturers? The answer is simple protectionism. The good news is that battery costs have been declining while charging stations are proliferating. The conditions for widespread adoption look increasingly feasible. Biden's goal is surely sound, but indulging his union backers at the expense of nearly everyone else is the wrong way to get there. This editorial was written by the Bloomberg Opinion editorial board. I'm David Shipley. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPI and Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, just about 10 minutes left in today's trading session. We are on Fed decision eve.
Yeah, that's...
Last Fed decision of the year.
Oh, to be a fly on the wall, right?
Oh, my gosh. I wonder.
I mean, we get the minutes, but...
Yeah, a few weeks later.
Yeah.
And then I guess we are then. We are then.
Yeah, we're just nerds.
All right, we are nerds. Having said that, you heard Charlie breaking down the trade here. We're definitely off our lows of the session, but we are seeing some selling, particularly when it comes to some of those tech names. Let's see what Jimmy Lee has to say. He is founder and chief executive officer of the Wealth Consulting Group. He joins us on the phone from Mexico. They are, by the way, an independent wealth management firm, a registered investment advisory firm that has about $2.7 billion in assets under management. And he is on the phone from Mexico. How are you?
Great. How are you?
Doing okay. I feel like I have more questions than answers in this environment. And having said that, despite even when we see some pullbacks when it comes to the equity trade, let's not forget we're pretty much near record levels. What's your read on this financial market situation?
Well, I think what you just said is very important. We're at near record levels. So through last Friday, my records show, according to LPL Research, S&P was up over 27%. So if you combine that with the returns from last year, I mean, we've had a nice 2 years in a row. So getting a little bit of a pullback on potentially a more hawkish Fed is something I think is very expected. And what I think will continue to happen, as we've seen all throughout this year, is that investors buy on the dip. And of course, we really haven't had any large dips yet. We haven't had a real correction. And if we did, I think that investors would go heavy, and especially into the sectors, I think, that have been beaten up recently with the idea that the economy is going to shut down again, you know?
Mm-hmm.
What kind of dip, though? Because, like you said, we haven't really had a significant dip, especially when you put it in the context of the rise in the S&P 500 that we see this year, and we're likely to see this year, and that we saw last year. Apart from, of course, March of 2020, when it was like, the dip of a generation, right?
Right. I do believe there are some companies that have corrected pretty good off their highs, but overall the market in general has been, staying very high because of the big tech names that are being hit today. They've rallied, and they've done had some really great returns. The big mega cap technology stocks that people were climbing into during the pandemic, they're rallying again as of late, carrying the big indexes like S&P 500 back up to record levels. And so I think we've had this, rotation of when we get negative news about COVID, selling off of the stocks that are in the travel and leisure industries, the cyclical stocks, and then people rotate back into the big tech. Obviously today that's not happening, and we're getting a little bit of sell-off all over the place. But I would say that overall, I don't think we're going to get a dip of 10% or more. I actually wish that we did, so we could be more aggressive.
Yeah, a lot of people on the sidelines wish that.
I really wished we did, but I don't think we'll get it, because I think at the 3, 5, 7% type range, you'll get heavy buying, because while the Fed will potentially taper quicker, depending on the data about inflation,
right?
It's still accommodative. I mean, they're still buying bonds. Interest rates are still, at all-time lows. So I would say that's a very good environment for equities.
Okay, so we're seeing the Nasdaq down more than 1.1% right now. Do you think this? So you're essentially saying this isn't the start of any sort of potential sell-off that could trigger some sort of opportunity to buy. You think that the dip buyers rush in already to prevent that?
I do. I wish it was, like I said, but I don't think it's going to happen. And so maybe we end up, with a little bit of a setback and maybe a little bit of a Santa Claus rally. I don't know. Obviously, for traders, any news regarding inflation, or if Powell changes his tone, which I don't think he will. I think they've learned their lesson. The Fed has in terms of not doing it the way the old Bernanke days, where we would guess like which hand his briefcase was in to see what the sentiment was going to be.
Bernanke, I'm thinking Greenspan, right? When he was walking up Capitol Hill.
Sorry.
Yeah, or walking into the Federal Reserve.
Thought about the wrong chairman. But yeah, it was a lot of that is to do with low interest rates. We may get an interest rate hike towards the second half of next year, but still very low interest rates. And every quarter, I can't remember the last quarter, I looked at the results of corporate earnings, and said, wow, it's unbelievable how well companies are performing in this environment. And I think that's going to continue to happen. I think that the companies that are short on labor, meaning it's been very difficult to fill jobs, I think that's going to change to the better. I think the supply situation is going to change to the better. So you're going to see some of the prices of some of the areas that have gone up the most, home building, for example. I think that's going to end up getting better towards the latter part of next year.
Yep.
And so I think there are some things that are going to improve on the supply side that'll help out with inflation data.
Right.
And the jobs. I think I think the job situation is going to be great. I think companies are going to continue to do well.
All right.
Yep. And I really think that it's going to be important to be active. Certain sectors of the economy will do much better next year than others.
All right, we got to run. Hey, thank you so much. Jimmy Lee, founder and CEO at the Wealth Consulting Group, a registered investment advisory firm with $2.7 billion in assets under management. All right, coming up next, we're going to be joined by our Bloomberg TV team for Beyond the Bell, live on Bloomberg Radio, TV, and YouTube. We're counting you down to the close on this Tuesday.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic, Taylor Riggs, Kelly Lyons in for Caroline Hyde. We're counting you down to the closing bell. Here to help take us beyond the bell. It's our global simulcast with Carol Masser and Tim Senovic, bringing together our Bloomberg television, radio, and YouTube audiences worldwide to parse the crucial moments of the day. 2 straight days here to start the week. 2 straight down days, I should say 4 down days now for the Russell 2000, all ahead of what some people say is going to be one of the more consequential Fed meetings that we've had in some time.
Yeah, and it's hard not to wonder, like, what are investors worried about? I mean, to see the markets, and while we're off our worst levels of the day, nonetheless down across the board. And you do wonder, are they concerned about the Fed becoming more hawkish, or are we going to be parsing through, we will be, word from word to figure out what does it mean to be a hawkish and figure out exactly where the Fed stands tomorrow. We'll know 24 hours from now.
Well, just taking a look at yesterday and today on the NASDAQ Composite, down 2.6%. We just spoke to Jimmy Lee, the founder and CEO of the Wealth Consulting Group. He said, hey, he doesn't expect any sort of broad pullback because he continues to see dip buyers, as they've done this year, come in and buy the dip. So for those people who have cash on the sidelines, he says, not going to be an opportunity in the near future to get in.
Really good point. I know, Tim, that we've been having these conversations pretty much all the last 2 days about TINA and the relative value. And Kayla, it's really hard to make the case for that when you can't even get above a 144 on the 10-year. Even though Nancy Tangler, who we were just speaking to on TV, talks about things being fairly valued, how do you describe that in a world where you can't even get 150 on the 10-year and on an inflation-adjusted basis, that number is negative?
Yeah, negative real yields, obviously a big beneficiary to risk assets. Even if they aren't feeling that so much today, Romaine, that is what a lot of people point to when they say, you know, risk assets can rally on.
Yeah, at the top of the loser board, it is a lot of those big tech names, which we'll get to in a second, like Microsoft, Adobe, Apple, also in the red. The Dow Jones Industrial Average down about 100 points here on the day, roughly 0.3%, we'll call it. As far as the S&P 500, 4634 and change. That's going to be your closing number here, down about 35 points or 0.7%. The NASDAQ Composite down 1.2% or so here, about 175 points, and more importantly, back below that 50-day moving average, 15,237, and the Russell 2000 down once again here. This is the 4th straight day of losses that we've seen on the Russell, still below that 200-day moving average. Your closing number, Carol, right now looks to be about 21.59 and change.
And I feel like when we go into a really important Fed meeting, whenever we're thinking about important moves or rotations in the market, you know, keep in mind, and our market guest just talked about this, the S&P is up more than 40% since the end of 2019. The NASDAQ 100 is up 82% in the past 2 years. The SOX is up more than 100% in the past 2 years. We have had a tremendous run in the last 2 years, and you do wonder, I guess, at this point, can that momentum continue?
I know, but what those stats you just cited, isn't that exactly why a lot of people think we're sort of overdue for a correction?
Exactly, but yet then we still have everyone kind of assessing where else does the money go at this point, especially with there's so much money sloshing around. And we'll see if there's more, if the money continues to slosh, you know, based on Fed policy.
Well, and it's Fed policy that has provided so much of that liquidity that has allowed markets to reach the levels where they now sit. As far as the levels we saw today, broadly, of course, it was a down day for equities. What's interesting is basically the only thing that did well on the day was the financials, basically anything tied to financials, the banks, the insurers, the diversified financials. Everything else mostly was in negative territory. A lot of those tech players obviously underperforming. The biggest laggard in terms of an industry basis was software and services, down 2.8%. Adobe was a big drag in that, Carol.
Yeah, really tough to be in that space. A lot of spaces today. It was hard to be
before you get to your movers here, can I just point out that Chile's central bank just raised rates to 4% from 2.75%. Now that's a boss move, right? Like, we're not going to get that out of Powell, right? There's no way. I mean, we're not getting a rate rise, but if he did it, he'd probably do it by, like, you know, 1/10 of a percentage point.
And Kaylee had an earlier point about Argentina. Is their central bank at least thinking about how to handle some of these rising inflationary costs?
And that inflation in Argentina is north of 50%.
Weren't you just in Argentina?
Level. I was just in Argentina.
So you must have done well with that exchange rate, right?
I did pretty well, yeah.
Okay.
Bring a lot of cash if you're planning a trip.
Yeah, that is wild, right?
All right, Carol.
We know the Fed's not going to do that. They're going to spoon-fed. You know, they're going to spoon-feed everything to us. We know that. All right, let's talk about a couple of the movers and a couple of the winners in today's session. Uber definitely popping in today's trade, up about 4.3%, off its best levels of the day. It was up more than 7.5% at its highs. This after the Uber CEO made some encouraging comments. Romaine mentioned it at an event last week, a fireside chat. We don't know if there was a real fire, but nonetheless, it was called a fireside chat over at UBS, saying last week was going to be
one day on the show. Can we have like a fireside chat?
We do that every day. It's just
How would that
there's
play
no
on radio?
actual
Only
fire.
if you wear a
Get the Yule log on
the
Netflix.
crackle. This is perfect for Christmas. I think you and I, Carol, are actually going to be
Chestnuts
broadcasting together.
roasting on an open fire.
We've done it in the past, but I
We
don't
have.
think we're going to
And when I did it with Carol, I should point out,
Tiny
every guest, it was all just like, alcohol and like, sin stuff.
You liked it.
I assume
I
that's all
believe
you
you.
do over
I
there.
even
We have
think
fun here.
I even think you wore a smoking jacket, so it really worked really well. Anyway, last week, some comments. The Uber CEO saying it was Uber's best week ever in terms of overall gross booking. So anyway, a pop in that stock. Number one in the S&P 500. I'm going to be serious. What a bummer to have your stock be the number one in the S&P 500 when you say you're going to resign.
Yeah, I mean, he was there for a long time,
I know.
too. And
Well, it
wasn't
built
he
up
there
the
for like
company.
20 years.
Yeah.
And there were a lot of activist investors kind of circling the stock, too, trying to
I know.
okay,
Exactly.
yeah.
And I just want to mention DocuSign, top in the NASDAQ 100. Again, I know it's down a ton this year, but another bump up this year, up more than 3%. I mean, another bump up today. Tim.
When it comes to decliners, mega cap tech stocks are the story of the day. Microsoft doing its job of pacing declines, finishing the day down by 3.2%, but on a points basis, it was the worst decliner in the S&P 500, the NASDAQ Composite, and the NASDAQ 100. Adobe falling 6.6% today. This after getting software stocks got downgraded by JP Morgan. Analysts said there, hey, rising rates, among other things, are causing us to downgrade these software stocks. I also want to draw our attention to Robinhood. Down another day, 2.9% today, trading at $19.13. It hit a new low of $18.42 earlier in the day. It's down more than 72% from its August highs. This is a company that IPO'd just back in July.
Well, Tim, I bring it full circle. You talk about where we're in terms of rising rates. We got a little bit of that today. If we can go on over to the yield story, you're only up about 2 to 3 basis points across the curve. But I know Romaine likes to poke at me. We're still, yes, I get it, a 143, a 144 on the 10-year, and a 182 on the 30-year. So we're not looking at huge moves today. But Carol, I think that this, and again, Nancy Tangler, who we just had on TV, had hinted at this, that the bond market is sniffing out, is this a policy mistake? Are we looking at slower growth and lower inflation out on the long end of the curve? Or is that portion of the curve really being manipulated by some of those long end pension, you name it, buyers who are matching up some of the liabilities? And we're supposed to be looking at a 10-year, which frankly, I am shocked that we're at a 144.
It is pretty remarkable that it's still so low and that the bond market isn't saying something more significant. And I guess that's what's interesting. Steve Skanke, who used to work, he was a former Fed official, and or Treasury official, and I do wonder, does things start to, like I said to him, could it possibly that all of a sudden we see inflation fall off a cliff? And he said, yeah, it could correct itself. Like it could go back to more normal rates. And so this is what the Fed, you guys, are dealing with at this point, grappling with.
Yeah, and I guess it all comes down to communication. I feel like a few months ago we were talking about, I guess, how well Powell was communicating, how he was sort of guiding this market in a way that at least people were content with. And then, of course, after his appearance on Capitol Hill a couple weeks ago, that sort of changed. And you sort of wonder how he sort of guides now at tomorrow's press conference, whether there is a shift in tone or whether he kind of continues these blunt assessments.
Well, and speaking of guidance, Romaine, I know you aren't keen to look at it, but the dot plot, in theory, could provide the markets a little bit of a
This is great
catalyst.
television.
We don't have to show it, and our radio listeners won't have to see it. Romaine doesn't
Have
like
you
it too
seen this
much.
chart, Carol?
The radio listeners
for our
love
radio
dots
audience,
go.
it's just dots.
It's just, I mean, I call it the scatter platter.
I love our producers, by the way.
Yeah,
right on command.
It's a line. Folks, we're really sorry on radio, but
There
it
are
is,
dots.
you're seeing it, and it talks about what's going up in terms of expectations
tells
of
you
rates.
everything you need
we
to
all
know
know.
about
The
We
thing
all
about the
know.
dots is that it's not just about when the Fed lifts off, and I know we're all focused on that, when the first hike comes. It is about what the hiking cycle looks like, how quickly they go, and how high rates ultimately will get.
Well, two words, data dependent, guys.
It's MUFG and Steve Englander of SocGen who were mentioning that you go out to 2025 and it looks like a very different story than 22 and 23.
Well, what do you make, though? I mean, you may say data dependent. We didn't even mention the big PPI number, which was just astonishing. I mean, it was expected, but nevertheless astonishing. But what do you make of the Bank of America Fund Manager Survey, which showed everyone moving more into cash? I mean, they've already been pretty heavily weighted into cash, but now we're really seeing sort of this flood into that.
Right. This is the most, I think, since May of 2020, if I have that right. Yep. And so what's it telling us about the way they're thinking about a bias toward equities or potentially a bias away from equities right now, right? What do they think about where things are going to move?
So what's keeping up the markets then if everybody's moving into cash?
I don't know.
I thought you told me cash is trash.
Well, I mean, but look, as everyone we talk to on our show says, where else are you going to go right now? You can't really go to bonds, or you would have lost money, at least on a year-to-date basis, in most of the bond markets here. I mean, there are alternative assets out there, but then do you take that volatility and that increased risk that comes along with it?
I'm just going to put out there 24 hours from now when we're talking, guys, will we have more questions or less questions post that Fed meeting? So we will know.
That's a good question, Carol.
Thank you. I get one every once in a while. All right, that's going to do it for Beyond the Bell, our cross-platform coverage, our market wrap on this Tuesday. We're going to see you again, same time, same place tomorrow on TV, on radio, and on YouTube.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
I'm exhausted.
It's only Tuesday, Lemon.
I know, it is only Tuesday,
Literally.
Lemon.
Actually, that's
It's only
for once
Tuesday,
it's true.
Jay.
Yeah.
What?
Well, you're fortunately, we can kind of take a step back tomorrow and hear from the Fed chair and hear from the journalists who, including, right, likely our own Michael McKee, international economics and policy correspondent, Matt Bosler as well, who will be asking questions during the press conference. What's your question for Powell?
Well, I think it was interesting what Steve Skanke had to say specifically about how do you make sense of this labor market?
Yeah.
And, do we need to kind of reassess what is full employment? What is the really right labor market participation rate? And so I do wonder if things have changed.
Who on the sidelines does not plan on coming back?
Right.
Who on the sidelines is not coming back because of childcare issues or because of concerns about the virus and variants?
Rethinking their life, right?
Those people who want to come back but are choosing not to right now for those factors and others, what's the scarring that happens as a result of them being on the sidelines and out of the labor force for a significant period of time? What does it look like when they try to get back in?
Right. What does it do to future growth rates potentially? What if people say, you know what, we're gonna live on one salary, and we're gonna just cut back on our spending. Maybe we'll buy a smaller house, but maybe we'll go out in the country so the kids have more space to play outside or something. Like, I do wonder about these changing dynamics, and who knows? I love the arguments during the pandemic where it's like, all right, the big city era, it's over. We all kind of laughed at that because we've heard that before, and people have come back to the cities. But I do think people have taken a really hard look at their life and said, okay, how do I have more balance? Or let me rethink what really matters, especially when, for many of us, we were looking at life and death matters during the pandemic.
Yeah, I think one thing that we need to keep in mind, and it didn't come up in our discussion
so deep.
No, it's true, but Steve Skanke did say, from Keel Point, he did say that is sort of the one element that could derail any sort of recovery here, right? The idea that potentially there's another, I don't want to say another pandemic, but a variant.
We're not out of
the
this
Omicron.
pandemic.
Exactly. And that's going to come up a lot tomorrow, I imagine.
And look at how quickly the UK said, okay, we think like different.
Yeah,
go work at
from
home.
Yeah.
So that already means a certain amount of economic activity is going to be lost. You're listening to Bloomberg Radio. Carol Masser, Tim Stenovic. This is Bloomberg. All right, folks, you are listening to Bloomberg Business Week on this
Tuesday.
Fed decision eve, I'm going to call it. A couple stories that caught our attention. Pittsburgh becoming the first East Coast city to adopt a dark sky.
Yeah, this is pretty cool. Pittsburgh is the world's urbanization has made it increasingly difficult to see the stars in city skies, but that may be changing it, at least in Pittsburgh.
Yeah. Go ahead.
Well, I'm just thinking there was this, I think it was a meteor shower last night that, I saw
Did
somewhere.
You see anything?
Oh, of course not. I live in New York City. So and I was like, well, it would be nice to catch one of these things once in a while, but, the sky is too bright.
This is so cool. One of the things I love is when I get outside of New York City and sometimes you don't even have to go that far, but all of a sudden, you're outside and you look up and it's dark and the skies are beautiful and it's just this certain gentility. I don't know.
Well, you could go to Pittsburgh to do it.
I could. The Pennsylvania city announcing in August it will become a dark sky city starting in 2022, so that's next year, meaning that it will switch to lower wattage LED bulbs and add shades along bridges, roads, and other public areas. It's the first city in the eastern part of the U.S. to adopt such policies, but it joins other cities, including Tucson and Sedona, Arizona and Fulda in Germany in their efforts to reduce light pollution and increase energy efficiencies. I kind of love this.
Pittsburgh has budgeted $16 million for the streetlight project. It estimates it'll save $1 million in energy costs. The city's going to switch light bulbs in about 40,000 fixtures on the street and in public buildings to LEDs. They emit less blue light or short wavelengths that can have a detrimental impact on plants, insects, and other wildlife. It aims to complete the project within 18 to 24 months, but it expects to see the benefits of a dark sky even earlier.
So here's interesting. Since much of the environment's changes are spurred by the sun, excess artificial light can disrupt bird migration patterns or cause trees to turn green too early. It can also confuse the natural 24-day night cycle for humans. We know that. A darker sky has been found to have positive effects on mental health, with stargazing and less blue light playing a part.
Stargazing, that's what I'm talking about.
I know. I always think about the two in their showers, and I look up outside my house. I'm like, sometimes I can't even see the moon. It's like crazy. All right, you're listening to Bloomberg Business Week. Tim Stenovic, Carol Masser, and this is Bloomberg Radio.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Tape. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We begin with two developing stories. The commercial printer R.R. Donnelley & Sons says it has agreed to be acquired by Chatham Asset Management for about $897 million in an all-cash transaction after our shares of R.R. Donnelley down 2.9%. 6 current and former employees at Tesla have filed lawsuits alleging rampant workplace sexual harassment just weeks after another woman from the electric car maker's factory in Fremont, California, leveled similar accusations. Stocks lower today as the Federal Reserve gets ready to wrap up its final meeting of the year. Another report showing inflation running hot sank some of the most expensive pockets of the stock market. NASDAQ down 175 points today, down 1.1%. NASDAQ 100 index down 1%. Russell 2000 down also by 1%. The S&P fell 34 points, down about 0.7. The Dow dropped 106, down 0.3. 10-year yield 1.43%. Spot gold down 0.9%, 17.71 the ounce. West Texas Intermediate crude down 1.3%, 70.34 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So tomorrow we're going to get another read on retail sales, the data for the month of November. It'll give us some more insight into the mood of investors as the holiday shopping season, Tim, gets underway.
Elizabeth Ebert is Chief Information Officer and Advisory Partner for Consumer Packaged Goods, Retail and Logistics at Infosys Consulting. Liz joins us on the phone from Chicago. Liz, how are you?
I'm well, Carol and Tim. Thank you for having me on today.
Yeah, well, thanks so much for joining us. It's a really good time to be talking to you ahead of those numbers we're getting tomorrow, and of course, getting an understanding of how things are going as we get, well, T-minus, 11 days until Christmas right now. Give us an idea of expectations for holiday sales and what you're seeing.
Yeah, the expectations are all very positive. Coming out of October, the results were strong. Anticipate the same for November. It's a really strange time to be watching this marketplace and talking to our clients, just because there's so many factors that are simultaneously hitting. We've got the supply chain issues that we've all heard about. There's COVID, there's inflation, but there's also a really enthusiastic U.S. consumer out there. And even with international travel opening up, a fair amount of international travel on top of that. So the question is not if the number is going to be good. The question is really how good will that number be? And certainly it will be pumped up a bit by the inflation numbers that we're seeing, but nonetheless, we expect to see the trend continuing that started in October with a lot of the earlier buying happening in the market.
What are you hearing from some of your clients that you work with in terms of what's important to the consumer going forward? I mean, we've been trying to get a really good handle, Liz, on are people reassessing, maybe it's not both spouses working and maybe somebody stays at home. So they're reevaluating after the pandemic because there just feels like there's some dislocations certainly happening in the labor market, and maybe not everybody comes back to work post-pandemic. What are you seeing from your clients? And I'm just curious, through consumer and retail trends, maybe you're getting some insight into that.
Yeah, I think there's a fair amount of money available to a lot of buyers simply because we were so constrained in terms of spending on experiences and travel. So now with that money coming back, even if there is an economic decision in a family to slow down on some of that spend, so I think there's a fair amount of enthusiasm and momentum that's driving the positive effects. I think the consumer has had the expectation set fairly low just because of supply chain problems and how that's been communicated, so frequently, through even the nightly news, of course. So I think consumers are happy to find what they're looking for and are spending. And I think that some of the after effect or the morning after may hit in January. But I think the macro number is going to be very positive with most consumers participating fairly aggressively.
What about when it comes to compared to 2019? Because a good benchmark that a lot of companies like to follow is before the pandemic hit. Where are we at levels compared to 2019?
Yeah, most of the gap between 2019 and 2021, I think, is going to be made whole. What was interesting, I think, is just watching the consumer changing their behavior over the past few weeks. We saw reports of shoppers returning to bricks and mortar locations, partly because of the uncertainty around supply chain. People wanted to know that they had their hands on the gifts they were looking for. They didn't have to worry about, a tanker in the Pacific or, FedEx or UPS delivering. So, I think with that in particular, it's going to be nearly what we saw in 2021. If you look at the total sales for the holidays over the last 4 years, the total sales have been coming in at a fairly tight range. But with this year, we think with the effects of inflation as well as the improvements in the economy and higher levels of employment, we're likely to see a record year.
What would surprise, do you think, maybe some of our audience? I think it's a smart audience, it's investors, it's people running companies, it's people from all walks of life, what they might find interesting about the retail environment right now.
Oh my gosh, there's so many interesting things. I think what the big issue that retailers are still working through is the new reality from COVID. You have to remember that everything for retail changed. And, we talk a lot about omni-channel and omni-commerce and being able to buy online and return in stores. And I think people would be really interested to hear that is very, very complicated for retailers. And behind the scenes, it takes an incredible amount of manpower. And right now, manpower is pretty scarce. But it takes a lot of effort to make all of that happen for a happy consumer. So I think what we're going to see moving forward and what we're working with our clients on is what are the new ways that we can present a brand and have our consumers experience a brand coming out of COVID, coming out of the supply chain problems that is really going to be very exciting. So whether it's going to be, virtual reality experiences or new ways to experience a product. One thing you have to remember is over the past few years, we've seen astronomical levels of returns. 50% of holiday shipments some years have been returned, and that's not good for retailers and it's not good for our environment. No. So I would say really interesting solutions to some of these business problems that we're starting to hear about. They're kind of bundled under supply chain. I think it's going to be a really exciting time, not only to be a retailer and a merchandise leader, but also to be a consumer to see the new ways that our brands are participating in the marketplace.
And Tim, I'm thinking about the NFTs we talked about with Chris Rouser in the retail space and luxury goods, right? Shopping in like the metaverse.
Yeah, thousands of dollars for this virtual representation of a handbag.
Yeah, it's like things are changing. They're really leaning in. Liz Ebert, Chief Information Officer and Advisory Partner for Consumer Packaged Goods, Retail and Logistics at Infosys Consulting.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
You are listening to Bloomberg Business Week. You've got a great story coming up. It's the Bloomberg Big Take on the Bloomberg Terminal.
Yeah, this is a great one. This is about a company that is a Silicon Valley darling, though. It's based in Denver. It's all about free college through tuition assistance at Guild, but that comes with a big asterisk.
Yeah, and we hear about this from a lot of some various companies and CEOs saying, here's what we're doing to help their workers. Anyway, deep dive in just a moment. In the meantime, let's get a deep dive into the market and trading day now that the bell has rung for the day and closed. Hey, Charlie.
Indeed, clang it did, Carol Master. The Dow, the S&P, NASDAQ all lower today, with the S&P slumping another 34 points off session lows, but red on the screen down 0.7%. The Dow dropped 106 today, down 0.3. NASDAQ tumbled 175, down 1.1%. 10-year down 7.30 seconds. 10-year yield 1.43%. Spot gold down 0.9%, 1771 the ounce. Bitcoin today higher now by 3.2%, back above 48,308 on Bitcoin. Crude, West Texas Intermediate down 1.2%, 70.44 a barrel. As the Federal Reserve gets ready to wrap up its final meeting of the year, another report today showed inflation running hot sank some of the most expensive pockets of the stock market. Well, as for today's selling, Jimmy Lee is the CEO at Wealth Consulting Group, and he was our guest right here on Bloomberg Business Week.
Getting a little bit of a pullback on potentially, a more hawkish Fed is something I think is very expected. And what I think will continue to happen, as we've seen all throughout this year, is that investors buy on the dip. And of course, we really haven't had any large dips yet. We haven't had a real correction. And if we did, I think that investors would go heavy, and especially into the sectors, I think.
Some of the stories that we're following: J.P. Morgan Chase will require vaccines to enter 9 Manhattan office buildings, including its headquarters at 383 Madison Avenue. That mandate takes place tomorrow, according to an internal memo seen by Bloomberg News. The coffee giant Starbucks has ordered a full inspection of every branch in China after undercover reporters discovered staff in 2 of its outlets using expired ingredients. Starbucks shares lower today by 0.7%. The commercial printer R.R. Donnelley & Sons has agreed to be acquired by Chatham Asset Management for about $897 million in an all-cash transaction. 6 current and former employees at Tesla have filed lawsuits alleging rampant workplace sexual harassment only weeks after another woman from the electric car maker's factory in Fremont, California, leveled similar accusations. Amtrak says it will not reduce service on long-distance routes in 2022, which it previously planned, due to an expected shortage of workers when its vaccine mandate takes effect. And New York's COVID-19 hospitalizations have jumped 70% since the Thanksgiving holiday, prompting officials and businesses alike to reassess their policies in an attempt to blunt a winter virus surge and the onset of the new Omicron variant. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much, Charlie. So, how to get rich sending low-income workers to college. I have to say, Tim, I read that headline on this story, and it says so much.
Yeah, I couldn't stop reading it once I started this story. It's a fantastic piece in Bloomberg Markets. John Heckinger is features editor for Bloomberg Markets. He joins us on the phone from Boston. John, this story all about Guild Education and the 33-year-old founder of this company that's based in Denver. First of all, for people who perhaps aren't familiar with Guild Education, it's a company that works with Walmart, Disney, Chipotle, other companies as well. What's their premise?
So, I mean, that's right. They act as a kind of broker for higher education. They match up workers at those big companies, often frontline workers, with education programs at universities across the country. And in return, they get a cut of the tuition, as much as 30%.
A big cut.
That's the business model. Yes, a big cut. And, it sort of addresses a huge problem in terms of, increasing the skills of the workforce. But we took a pretty in-depth look at how it works out for the students.
How does it work out?
Well, we looked at Walmart, and Walmart has enrolled about 50,000 students in the program, but about 400 have gotten college degrees. And so it's been, it hasn't been around that long, but not too many have gotten even a 2-year associate's degree. And this, the company says that it hasn't been around that long, and that they will eventually. But we've also, spoke to some of their employees and some of their partners who have said that many of the students weren't really prepared and didn't have enough sort of coaching in getting to the program.
We'll talk about that in just a second, but it's worth repeating this number because it's just shocking here. So according to a recent study of roughly 56,000 Walmart workers who've participated in the tuition assistance program it created with Guild, only about 400 of those Walmart workers have earned a bachelor's or associate's degrees. That's since 2018. So you said that the company has its founder, Rachel Carlson, has said that it's too early to gauge graduation rates. But what did you guys find in your reporting that is holding people back?
Well, one of the main service that the company offers is coaching. So the idea is that many frontline workers who are busy with their schedules have trouble finishing, particularly online degrees, which require a lot of concentration. And so what they're saying is that they can sort of hold people's hands and get them through it and make sure that they complete the program. But what current and former employees told us was that there were very high caseloads. The company's growing really fast, and sometimes each coach had to handle between 300 and 1,000 employees, and so it wasn't really possible to get people through.
It's like the same problems you see in, mental health care or social welfare. I mean, you just see social workers, right, who have such a high caseload, and unfortunately you cannot give the same care to everyone when your caseload is so high. Is that the real problem? Is that it ultimately?
Well, I think it's challenging for any working adults to finish online degrees. Yeah. It's a major problem. And I think, they've been lauded for their very, sort of creative approach to doing this. But it turns out to be a lot harder than it looks. And, one of their first big partners was the University of Florida. And we reported on emails that showed that they felt like they were getting a lot of unprepared students. And, in the end, they terminated the relationship. So it's been rocky, rockier than I think a lot of people realized. But hopefully over time, many more of these students will get degrees.
The company is described as a darling of Silicon Valley, even though it's based in Denver, and that certainly caught my eye because it has raised so much money from Silicon Valley companies. But a big part of this story focuses on who exactly Rachel Carlson is. So give us an idea, because before reading this, I had no idea that she was part of essentially Colorado royalty.
That's right. Her family is sometimes described as the Kennedys of Colorado. So her grandfather was the governor of Colorado, a very prominent, an important figure nationally, Roy Romer. And her father also ran charter schools and ran for mayor of Denver. And her uncle is a Nobel Prize winning economist at NYU. So it's a very distinguished family that really has cared about education for a very long time, and it was clearly an inspiration for Rachel Carlson. And she's very open with the idea that she went to Stanford and Stanford Business School, and so she has sort of elite credentials and comes from a prominent family and has as she said, born on third base. And what she wants to do is give try to give other people a chance. And one of the interesting things about the model is that it is a for-profit education company on some level, but the ones that ran into trouble were those that got students into debt. And here's a case where companies set aside billions of dollars that often isn't used. So that can be harnessed. maybe that could make a big difference.
It's an incredible story, and it really does speak to and that question of, would education solve and help a lot of individuals out? So much in this story. John Heckinger, thank you so much for sharing some time with us. Features editor at Bloomberg Markets on the phone from Boston. You're listening to Bloomberg Business Week. This is Bloomberg Radio. Well, speaking of colleges and academia, there is a story by our colleague Janet Lauren of Bloomberg News. She follows higher education, the money of higher education, and she's got a story out there on the Bloomberg that is entitled "Colleges Embrace a Post-SAT Future Driven by Pandemic Necessity." Having recently gone through the college application process with my daughter, where for the first time they basically got rid of SAT or ACT scores that wasn't really a key metric. It was optional for most schools. But this has been something that, as students who applied, it was all about taking these tests. You knew that was going to be an important metric to the schools you were applying to.
I was, about 20 years too early for this to happen, unfortunately.
Well, and it's interesting. And she says high school juniors applying to Stanford University can stop studying for standardized tests. The school isn't requiring them. Columbia said last month it won't require scores from students who are now sophomores or juniors joining Cornell and Amherst College. And the 280,000 student University of California system has declared no testing for all freshmen who may apply to its 10 campuses.
So optional, does that mean that there's sort of extra credit? Like if you submit your test results, it means you did well. But if you don't submit test results, it's like, okay, well, I didn't do well, so I'm not going to submit them.
And this was the question, because even if you did fairly well, I know there were lots of questions that, I know my daughter went through with, her college advisory team at her high school. It's like, should you do it if you did it? Are you penalized? Is it a helpful metric? And I guess my question is to universities and schools, would you really still like to see it? Is it a nice dividing line for you when you're deciding, especially when you get thousands and thousands and thousands of applications?
How do you separate the applicants?
What's more important? What's really important then?
Right, and for years, we were told the story about how these test results are indicators of, or the opposite of, are indicators of success, at least with GMATs, right? Success in business school or in graduate school, LSAT or ACT for undergrad. I don't know. I don't know the answer here.
It's really provocative, and we'll catch up with Janet soon to talk a little bit more about this. You're listening to Bloomberg Business Week on Bloomberg Radio.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Peloton. The eve of the Fed decision, a down day for the Dow, the S&P, and NASDAQ. We did finish off session lows, but as the Federal Reserve gets ready to wrap up its final meeting of the year, another report showed inflation running hot. That sank some of the most expensive pockets of the U.S. stock market. NASDAQ down 1.1% today, down 175 points. The NASDAQ 100 index down 1% today. S&P tumbled 34, down 0.7. The Dow dropped 106, lower by 0.3%. 10-year down 7/32, 10-year yield 1.43%. Spot gold down 0.9%, 17.70 the ounce. West Texas Intermediate crude oil down 1.4%, 70.26 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, got it. You are listening to Bloomberg Business Week. Carol Master along with Tim Stanovic. Well, late last month, we talked with Ali Goldstein, L'Oreal Paris USA president, and we talked about a lot of things, but in particular about the company's Women of Worth program, which highlights women who are agents of change. One of those women joins us now. She's L'Oreal Paris USA Women of Worth honoree, Brianna Daniel of Street Team Movement, and she joins us in our Bloomberg Interactive Broker studio wearing a Women of Worth or Worth It hat. Welcome. Congratulations on being part of this group.
Thank you. I'm honored to be here.
Well, it's really remarkable about the women that are always honored by L'Oreal. And often it's women who have experienced something, gone through something, and then thinking about how to be truly an agent of change and reach a wider community. Tell us about Street Team Movement and how this movement came to be. What was the moment?
Oh, man. So Street Team Movement is a nonprofit organization that provides hygiene to the homeless community through vending machines. So they're able to access the hygiene items for free to them through a card that is called the Hope Card. It's registered to our homeless friends, and they are able to swipe. They get 3 swipes a week, which is 3 either hygiene pouches a week. They can also vend out a 6-in-1 laundry product and take it and get a load of laundry washed and dried all through the vending machine as well. So the moment we started Street Team Movement, it was just after college for me, and I moved to near downtown Orlando, and I realized that the homelessness was a problem. It was something that was just staring me right in the face, and then I decided to take action, and I actually lived on the streets homeless for 32 days to actually understand what the homeless were experiencing, what their struggles were, but most importantly, what did they need, and how we can best meet those needs.
Wow, it's incredibly powerful because people a lot of people who work with people who are unhoused don't actually go through and have that experience, let alone have that experience for more than a month. What specifically did you learn about people, and like you said, our friends who are unhoused?
Yeah, I learned that there's a lot of services being provided, at least in the metro downtown Orlando area. There were a lot of food services that were being provided. One of the things that we noticed is that people would literally stop their car and just have, groceries in their car, and they just give them out. There's so many good intentioned people and good-hearted people, and that was something that I really noticed that was great. But I think I also realized is that consistent programming was something that was needed, specifically for hygiene. There was no one that was out there providing laundry services. We didn't have consistent access to showers. There was something that was a gap. So Street Team Movement ultimately did become a gap filler because we saw a need and we went in there and just dominated it.
Brianna, I always think people often think, well, the solution is put people in shelters or have them to shelters, and that's how they do it. But there's a lot of people who don't, because a lot of times shelters aren't a great place to be.
They're not a great place to be, especially for our homeless women with children. There are oftentimes people with criminal records in there. There's oftentimes people that are they're pedophiles in there, and it's tough. First, being in the situation of being homeless, but also trying to protect your family, trying to protect the innocence of your kids. So oftentimes, you're led to make tough choices when you're out on the streets, especially as a woman.
Talk a little bit about the Women of Worth and being an honoree there, because as Carol mentioned, when we did speak to the folks from L'Oreal just a couple of weeks ago, we learned about this amazing network of people who come together. And in the more than 15 years that L'Oreal has been doing this, it sort of turns into this idea of staying in touch with this amazing group of women and people all over the country who create this network.
Absolutely, and you use the correct word, Tim. It's the network. It's absolutely amazing. Over 160 women strong. So to be a part of this fantastic, not just the Women of Worth organization, but just the L'Oreal Paris previous honorees, and really just being able to connect with them, seeing what they have taken away from the program and what they're doing. It's just, honestly, it's such an honor.
All right, I want to take you back, though. Tell me about, you said you lived alongside Florida's homeless population for more than a month. How do you do something like that? And how do you do that without being offensive, or it's uncomfortable for people who are living on the street? Like, how do you do that? Tell me about that.
So honestly, Carol, it was more so, I was young. So at the time, I was 20 years old when this happened. And our homeless friends just wrote me off. They thought it was a teenage runaway. So I kept to myself a lot of times. I asked a lot of questions, but more so came from a place of just ignorance. I didn't know what I didn't know. Yeah. And there were people that were willing to come alongside me and help me, let me know what time certain organizations are coming out and they're providing food, or which shelters are providing showers, what day is this happening, when is someone doing haircuts or anything, so they really were able to come in and let me know the ropes, so to say, while I was out there. And it was incredibly scary, especially being a single woman on the streets.
Because you were there at night?
Yes, I didn't sleep. I want to say the first 2.5 days, I didn't sleep until I found a place to actually sleep. So it was really great in theory until it gets dark and downtown is completely deserted, and it's just you standing there with a backpack and no plan. And that's when it becomes completely real to you that you have some choices to make. And thankfully, I ended up finding a really safe place to sleep during the rest of the time that I was out there. But it was incredibly scary.
What did you learn about? Look, this is a crisis happening throughout our country. What are some messages for policymakers about understanding the homeless population and how we can actually combat it?
Yeah, that's a really great question. And that was actually one of the biggest struggles for us our first years with Street Team Movement, Inc. And it was speaking to our policymakers and letting them know that what we provide as hygiene is not a luxury. It is a necessity. Yep. And I remember standing in a council meeting.
It's amazing that you even have to say that, right?
It was so insane. And I said, okay, show of hands, who showered today? And every hand went up. And I said, stop showering. If it's such a luxury, just stop doing it. Mm-hmm. You can't, because you need to do it. You have to brush your teeth. There's things that you need to have access to. And it's not just a health issue. It's not just a health crisis. It's confidence. It's self-worth. And you see yourself better. You see yourself as a human. You start acting differently. You start believing that there is hope and someone sees you and someone cares about you and that there's hope for a brighter tomorrow, not just the situation that you're in.
Where do you want to take it? We've only got about 40, 50 seconds left here. What's your thoughts about how you continue your work and where you want to go with it?
Absolutely. We have our amazing hygiene vending machine model, and I would love to see those in any city that absolutely wants one.
Great idea.
Yeah, any city can have one. You can swipe the same Hope card in Orlando as you could in Chicago, anywhere. So honestly, go to our website, streetmovement.org, find out how to get a vending machine and get plugged in.
Who gets the cards? Who's funding them? Just quickly.
We give out the cards, we fund the cards.
You fund them, okay. So working with cities, towns, states to maybe hopefully be a part of this?
Absolutely, and it's completely free to our homeless friends.
All right, great stuff. Stay in touch, let us know how things are going.
Absolutely, thank you so much.
And congratulations, it's really, really amazing. Brianna Daniel, she is of Street Team Movement, founded it, is doing this work, and is part of the L'Oreal Paris U.S. Women of Worth. She's in one of the honorees, but again, it's just understanding a situation and coming up with a solution and changing people's worlds.
And really immersing herself, too.
Mm-hmm.
Wow.
Absolutely.
More than 30 days homeless.
And that's how you get to see something, right, up front and really understand it. All right, folks, coming up next, Sound On with Joe Matthew, taking through the day's news out of the nation's capital. For Tim Stanovic and the whole Bloomberg Business Week team, I'm Carol Massar.